Some of these companies will let you 5x, 10x, 20x. When the stock market's entering a nasty mode, it wants to cause maximum damage out there. Psychological warfare going on out there, like damage. And everybody that, was so excited about stocks only going up, the strong survive, they make it out to the other side, and they make more money than they ever dreamt. The growth rates have already started to skyrocket. It's just, we're going to take it to another level. 2020 through 2029, we're in a decade right now of just craziness. There's going to be massive moves down, massive moves up. We're going to have some time periods when things look really bleak. Everybody's depressed on the market. One of the most underappreciated turnarounds, I think, in the stock market right now. That's the next big, huge thing, and you make more money than you ever dreamt. In the past 5 years, Bitcoin's up 403%. Generational buying opportunity. This shows you big tech is more important than the Federal Reserve nowadays. These are sorts of opportunities that you can double, triple, quadruple, 10x, or more your money in these stocks over time. We are not in an AI bubble right now. You know how I know? What a week it was. Wow, I think everybody's flapjacks got a little burnt this week, huh? Okay, folks, we got a lot to go through in this video here today. Man, was I buying some stocks out there this week. Holy smokes, this ain't no dang jokers, okay? Right off the bat, I want to speak about Bitcoin quickly in this video. You know me, I don't talk much ever about crypto, but it is important I explain what's going on there and the ramifications and why it matters to the stock market, because it's actually significant why it matters to the stock market. So we'll speak about that. Then we're getting to all 14 stocks I bought in my different portfolios this week, private portfolios, public portfolios, all that good stuff. We'll get into all that in this video here today, okay? From there, I want to react to this video. Don't think there's much fear in this market at all. And this is a very interesting comment because I just posted this on X last night. Fear and greed index now at a 6. We're in extreme fear territory, and yet this gentleman is saying there's not much fear in this market at all from JP Morgan. So this is going to be an interesting one to react to. Then I want to react to this one. Oppenheimer's chief investment strategist says it is now time to buy the dip. So looking forward to reacting to that. Just got a lot to go through in this video here today, folks. All I need from you is one thing only. If you could just hit that little thumbs up button, that little like button, that's all I need from you. I appreciate you for doing that. Thank you everybody that's already done that. And also make sure to subscribe to the channel if you want to see more of my videos in the future. 122,000 plus subscribers strong on the channel. Pinned comment down there today. We are now only 6 days away from the massive once a year Black Friday sale I do, and we're doing it for 1000x this year. Huge deal. It's going to be 51% off a monthly membership and 50% off a 3-year membership. So whether you want to join on a monthly basis or a 3-year basis, that's entire access to the entire 1000x platform. All the advanced metrics, as well as our entire education portion here of 1000x education, which should help a lot of you guys out immensely. So you definitely want to take advantage of that deal. It's well worth the price of admission. Pinned comment down there. Click on that, put in your name, put in your email, and if you want to receive it via text, put in your number. You know you're going to receive a lot of crap on Black Friday from a lot of retailers, and this might end up getting lost. We're now up to 1,294 people signed up for the sale. So yeah, we should be at 2,000 plus before you know it, and everybody needs to get access to that, okay? Alrighty guys, so right off the bat here, Bitcoin, why does it matter to the market? Where's it going from here? Those sorts of things. Okay, listen. We're now in a time period where Bitcoin is very tied to the stock market from the respect of if people want to take on risk, they're going to buy things like Bitcoin. They're going to buy things like higher growth stocks. When these asset classes are going through trouble, a la Bitcoin, it can actually bleed into the stock market now at this point in time. Same way on the other side. If the stock market starts getting shaky, it can lead Bitcoin to start getting shaky, okay? But that's nothing new. The fact that now Bitcoin getting shaky is starting to lead to stock market damage, that's new. That's a new trend in the market. In my opinion on why this is now transpiring like that is because over the past, I would say, year or so, there's been so many Bitcoin ETFs that have popped up, and now it's become much more mass market to invest into Bitcoin, right? It used to be less like people that were like really in the know were buying Bitcoin. This is years ago. Now it's like, people in pension funds are now buying Bitcoin. Like it's completely changed the game, right? No, that leads to some potential problems there because I've spoke about this many times. And by the way, I'm wearing a hoodie here today because it's been raining all week here in Vegas. This is the most rain I've ever seen, I think, in my entire life. Well, in my entire time of living in Vegas. I moved out to Vegas in 2015. I swear it's never rained this much. Every single day it's rained so far this week. It's unbelievable. Kind of like the market's been raining, right? But Bitcoin now at this point in time, it's very tied to risk in general. And so what we're seeing is, a lot of weakness in Bitcoin, and it's bleeding right over into the stock market essentially, right? Now, what I'm showing you right now is the Bitcoin cycle, supposedly, okay? So based on this Bitcoin cycle, supposedly there's not supposed to be a bottom until November of next year, ladies and gentlemen. And at that time, Bitcoin's going to be like 29,000. That's according to this. Now, who knows? Okay, who knows? But this Bitcoin cycle, a lot of people do look at this and they put a lot of weight in this. And remember, the problem with Bitcoin is it doesn't come back to anything fundamental. It doesn't come back to earnings like it does a stock, where you say this is a silly PE because they're going to grow at this sort of revenue growth rate and all those sorts of things, right? It's not like real estate where you can say all the homes in the cities trade for around this price per square foot, this neighborhood's this price per square foot, so this house should be this price per square foot, right? Bitcoin, it's whatever the next guy's willing to pay for it. And so people look at a lot of these indicators like a Bitcoin cycle to make their judgments on where Bitcoin price is headed from here. Okay, so this is just very important for everybody to understand this. And so if you're thinking, is this damage about done? The answer is, if this Bitcoin cycle is accurate, it's not even close to being done. Like, this is just the warm-up phase. We're at the appetizer phase at this point in time, right? And supposedly there's supposed to be a bounce. So supposedly you're supposed to kind of bottom this baby out in, let's say, the low 60s, and that will be in January. And then from there you head up till about March, right? And then you start a massive downward trend, which, we'll see if that plays out. But remember this, if it does play out in the future, like, that's going to be pretty fascinating on that, right? Now, this leads to a bigger subject in why this matters to the stock market, is you got to understand margin. Margin, people just think of it as people taking out debt to invest, right? Or trade. And those numbers have gone sky high in the stock market over this, really since we came out of those April lows. We were down to 850 billion in margin. Now we're up to almost 1.2 trillion as of the recent numbers, right around market peak there. Insane. So now, if you think margin's bad in the stock market, understand that's nothing compared to what goes on in crypto. Like, the amount of leverage and degeneracy that goes on in crypto is a whole different level. And so when you're in one of these downward cycles, in one of these downward spirals, you're getting a deleveraging of all asset classes. Now, with that being said, my opinion is this is not a bad thing. This is a great thing. We need a deleveraging of margin. That's not healthy. That's not a healthy market. I want to see a deleveraging of crypto. I want to see a deleveraging of the stock market. Obviously, you'll never take leverage down to zero, right? It's never going to happen. But you can take it down to much more realistic numbers, and that I would love, right? If everybody's over leveraged, you're not in a healthy asset class. Think about the real estate market prior to the great financial crisis, right? And we heard all the stories about, the strippers buying 5 homes and all those sorts of stories, right? You heard back in the day, and the guy that, has 7 rental properties and, bought them all at peak prices and all those sorts of things. Like, that's not a healthy market when people are way over leveraged. I don't care if it's real estate, stocks, crypto, anything like that. Okay. And so when things are really good for a long time, which, keep in mind, things had been great in crypto for almost 3 years. Crypto bottom, Bitcoin bottom, around Q4 of 2022, just like stocks did. And then it was a 3-year massive boom cycle. When things are that good for that long, eventually you're going to start seeing people take out more and more leverage, right? Because they're thinking, man, I could make even more money if I just leverage this out a little bit. Why not, instead of just investing $100,000, I do another $100,000 on margin in crypto? Some of these companies will let you 5x, 10x, 20x. I've seen I've heard of about 100x leverage. It's out of control. All it can take is a few percentage points of a change downward, and you lose your entire portfolio. It's the most insane thing. But people do that sort of degenerate stuff. It's absolutely out of control. And so just understand what we're going through. This is healthy. This is needed. And what will emerge after this cycle essentially is a much healthier crypto market, a much healthier stock market, which I applaud. I applaud. And also do remember this. I think it's worth mentioning here. A lot of people are worried about the stock market and those sorts of things, right? Just keep this in mind, because people have been trying to bring it back to 2021. Listen, in 2021, people were buying NFTs, right? People were buying land in the metaverse and all this crazy, crazy stuff, okay? Right now, what we have going on in the financial markets, and when it comes to stock market at least, right? People are worried that things are too good. They're worried that Nvidia's revenue growth is not sustainable. They're worried about depreciation. These are actually, that's one of the healthier things you can possibly have in the market. People being skeptical of growth rates, people being worried about depreciation. Dude, that's extremely healthy. Like, we're actually in a very healthy stock market right now. People are all scared and worried about that sort of stuff. That's very different than 2021 when everything's going to the moon. The riskiest crypto and Dogecoin and all that stuff was going crazy, and NFTs, and that was just a whole different financial game. Right now people are like, I don't know if I want as much exposure to Bitcoin and Ethereum as I have, right? The two big cryptos. People are like, I don't know about if Nvidia can keep up these sorts of growth rates. I don't know, how's Meta's depreciation schedule going to be 2 years versus 5 years? This is actually intelligent conversation, ladies and gentlemen. This is a very different market than we had in 2021. So how do I feel personally in the stock market right now? I feel extremely good. I feel like maybe we could get a little more downside before year end, right? Get the NASDAQ down a few more percentage points. Maybe, we can call it maybe down 4 to 7 percentage points more. But I actually feel really healthy in this market. This is not a stock market that scares me. Stock markets that scare me is when everybody's only looking to the upside and they aren't considering the downside. And I think we have a lot of considerations for downside right now. And I think that makes for actually a really healthy market and a really healthy setup as we come out of this situation, okay? Alrighty, next up here, what are all the stocks I bought just this week? I mean, this was a ridiculous week of buying, 14 stocks in total. So what did I buy? What did I not buy? Holy smokes. Okay, so I bought Cheesecake Factory stock this week. Phenomenal deal on cake. Cake's obviously one of the, like a smaller cap stock, and those sorts of stocks that sold off heavy because a lot of those are even tied to, the movements in like Bitcoin, Ethereum, like risk on assets. People look at them, and if like risk on assets are selling off, you sell off the Russell too, right? And those small cap stocks. And so I love Cheesecake Factory here. Like, it's such a huge buy for me as a long-term investor. Like, this is the best situation that could happen. Like, all this weakness, love it. PayPal, phenomenal buy. Like, that's just silly valuation on PayPal. Like, remember, this company just grew revenue, 7% last quarter? And check this out. Okay? Look at that. A forward P of 11. Like, that's just crazy. Like, that's crazy. Like, there's no reason this company... Let me show you guys my projections for PayPal. My intermediate projections. I believe I have them here. Let's take a peek. PayPal. So this is one of the most valuable things, by the way, on 1000xstocks.com is the ability to run projections, plug in your different revenue growth, net income growth, P ratios, things like that. We also have our advanced projections. But look at this. This is my base case for PayPal. I am growing 7% revenue on average per year. 26 through 29, 9% net income growth, 18 to 23 PE, which would be very fair for a company growing at these sorts of growth rates, 22 to 29% compound annual growth rate on this company over the coming years. Let me show you guys how advanced projections look. This is for the big boys, okay? This is for the big boys. You really want to get into it? You run the advanced projections, baby, okay? And that's for the big boys there. So yeah, PayPal, great pricing on that stock. I absolutely love that one. And so, it remains a buy. Adobe is trading so cheap right now, it's almost laughable. I mean, let me pull up Adobe here to show you guys. Like, this is just ridiculous. Like, I can't believe this. Adobe's trading at a forward P of 18. Like, come on. With double-digit expected earnings per share growth, revenue growth in the double-digit range, like, that's no, should not be trading there. I think, just like Google was very silly how they were pricing Google earlier this year. Now look at Google. Google just broke 300. I think we're going to look back and be like, this is very silly how they've been pricing Adobe stocks. Just silly. American Express looks very good. American Express, have I showed you guys my American Express projections? I don't think I have. Let me pull up Amex here and you guys will see how. Keep in mind, Amex is one of the safer business models you can buy. It's a membership model, kind of similar to like Costco, I guess we can say. And what the heck? I didn't save my American Express projections. Dang it. Well, I'll show those to you guys in the future. I'll have to rerun those projections. I forgot to save it. Dang it. Elf stock, phenomenal buy there. Yeah, I love Elf. I mean, it's under $70, come on. Estee Lauder's got a successful turnaround going on. The numbers have already started to trend right. Nike, same exact thing. The numbers have already started to trend right. These stocks, I mean, Estee Lauder started to move. Nike still hasn't really moved at all. But the business models already have proven like they're on the right track now at this point in time. So I understand there's weakness in the consumer for this quarter we're in, whatever. Like that's going to be what that's going to be. I'm buying these stocks for the next several years. I care less about what their quarterly numbers are this quarter or next quarter. Amazon continues to be a buy. I understand everybody's worried about depreciation, but listen, I need to make this point in regards to Amazon stock. Listen, Amazon has always been an asset-heavy business model. Always. And so the fact that they're buying a lot of chips and they're building even more data, like, okay, that's what they do. This is nothing new for Amazon. So the depreciation situation, I'm not worried about that with Amazon. The margins, I'm not worried about that with Amazon. Amazon margins always been crap. Like, it's just the way it is. SoFi. I bought some SoFi this week. I know the stock's run a lot, but at the end of the day, I'm becoming more and more confident that SoFi is going to become an absolute giant in the space, and when I say in the banking space over the coming years. And so, yeah, I bought more SoFi. Celsius Holdings, bought some of Celsius this week. That one's a phenomenal buy under $40. CRM, Salesforce, bought some of that baby. AMD, bought some of that baby, which that might come as a surprise because I'm up so much on my AMD position, but it's still a buy. Like, it's still a buy in regards to AMD. Honest, that one's been hit hard, obviously with all the weakness in small caps and whatnot, but that one's a phenomenal deal here. And Fubo, I love that one as well. So all those stocks, man, 14 stocks in total. That was a big buy week. It almost never happens where I buy 14 stocks in a week. Like, that's I bought a whole dang portfolio of stocks this week. Like, don't think about that. Like, that's a full-blown portfolio of growth, value, and dividend stocks there, right? Cheesecake's a value dividend. PayPal's a value dividend. Adobe's a growth stock. American Express is a growth stock with value dividend components to it. Elf's a growth stock. EL's a turnaround play, value dividend. Nike's turnaround play, value dividend. Amazon's a growth stock. SoFi's a growth stock. Celsius is a growth stock. CRM is a growth/value stock. AMD's a growth stock. Honest is a value stock. And then Fubo's we can call it spec stock. So yeah, like, that's all. I bought a whole dang portfolio this week, man. Crazy. But hey, that happens sometimes, right? Okay, next one up here. Don't think there's much fear in this market. This one should be interesting.
A return fixed income group at JP Morgan Asset Management. We've had a wild ride in the equity markets. It's been quite a thing to see. These guys are stuck. Yeah.
Oh.
Given the inflation picture and the unemployment picture, they're smacking against each other in the wrong direction.
Look what just happened, ladies and gentlemen. Nvidia just went red. And look what I posted just a bit ago on my X page. I don't know if you guys follow me on X or not. I always have the link in the description area down there. But look what I just posted. I said, Nvidia wants to go red. Keep an eye on it this last hour of trade. It's been green all day. Dang, man. I might have to. Should I quote it? Yeah, I'll do it. Nvidia now red. Anyway, so yeah, that's a whole situation going on there. Hey, by the way, I posted something I think is really good for everybody's mentality watching this video. I posted this last night. I don't know if you guys got to see this or not. Looks like about 33,000 people got to see it. But I said, never get scarcity mentality when going through a market pullback, correction, or crash. Always remember, each year there are more millionaires, multimillionaires, and billionaires than ever before. Governments are always flooding money. There's no shortage of money in this world. And I always do think it's important that everybody keeps that in mind, that, like, don't ever get scarcity mentality in these situations. Like, it's going to be what it's going to be in the short term. There's plenty of money out there, plenty of money to be made, plenty of money to be invested. Like, don't ever, like, get short-sighted in regards to that matter, because a lot of people do. And then they think small when you need to be thinking big. When times are tougher in the market or in the economy, that's actually when you need to think bigger, not smaller. You got to think big.
Directions.
Yeah, what's interesting, Andrew, is 10 and 30-year yields are higher now than when Fed funds were over 5%. Right. So for all this easing, the long end isn't really responding at all.
And that's a really important point.
Yeah.
For all the pressure that's being put on the Fed to do this, they don't have control.
There's a lot of pressure
that are going to impact mortgage rates.
And just the mean things that are constantly said about Powell. I'm just like, good Lord. It's interesting. And, inflation's not going away. I mean, as a small business owner myself, I see it every day. particularly services. I mean, we're in the process of putting up a building, and you just can't believe aluminum, steel prices, labor costs just continue to move up. So this transitory element, I can't believe that word is still being used, is interesting to me.
Richard Lefebvre said the same thing. When we've had conversations on set about trying to get prices down for housing, he said nothing's going to come down until you can get construction prices down.
100%.
That's where you're still seeing a lot of this inflation.
Both commercial and residential. Absolutely. Yep, I totally agree. So,
what do you make of the markets, though, now and the implosion that we're seeing? I won't even call it
This is very entertaining what I'm watching outside my house right now, because basically my wife put out a bunch of stuff for bulk trash, like old clothes and old toys the boys aren't using anymore and things like that. It's just a pile up. And it's interesting. Like I just had a guy in front of the house with a truck. He was like putting a bunch of stuff in his truck. Now somebody just pulled up with a car. They're about to put a bunch of stuff in their car. It's interesting. And, like, a lot of times our stuff never actually makes it to bulk trash because people actually pick it up, and I bet you people like resell it, some of the stuff online, and they probably do other stuff like sell it wherever. Oh yeah, thank you. All those sorts of things. So it's entertaining.
Because you're down 4 or 5%. There's a lot of volatility. It's happening rapidly, and we've been used to a market that's gone nowhere but up for the last 7 months.
I think the credit markets are a tell here, right? And I think the sheer amount of debt that's been taken on, not only by technology companies, and especially in the case of, a lot of the ratings arbitrage you see going on, like a lot of this debt is being funded through special purpose vehicles or synthetic risk transfers. In the case of life insurers, they're moving a lot of risk to captive reinsurers, and, that creates issues and opaqueness. And, again, I get it. You have a stream of liabilities, these life insurers do. They want to make as much as they can on their assets. They want to do it in a way that reduces their capital charges as much as possible, right? So you move it offshore to a captive reinsurer, and you put a lot of private stuff in there that yields you a lot more. But the problem with that is, if you have an issue and suddenly these annuity and pensioners want their money back or want to withdraw, and you got to dig into the less liquid part, then you have a problem.
So
right?
you think we're walking into a private credit problem?
I think we potentially are. Yeah, I think there's been.
What does that look like, though, to you?
Well, it's hard, right? Because it's so opaque, right? There's no bid offer. There's no active bid offer. Like, for instance, you saw what happened. You've seen what's happened with a few of the firms just over the past couple weeks, where Renovo, which was marked at par on most people's books, suddenly just written straight down to zero because there's no bid offer. You don't know what it's worth until something happens, right? And then very often it's worth far less than where it's marked on the books. And that's the main issue. There's no active bid offer.
So the good news is it's hard for there to be a run on the bank in these contexts, I think, because you don't have this mismatch in terms of timing where a depositor can walk in and say, I need all my money back.
Right.
But the loan is still outstanding. And so what I don't know is when a loan goes bad, if you will, in the private credit space, or even an entire portfolio goes bad. When I say goes bad, meaning it is worth less than whatever it's supposed to be worth. Does the fund, some of these funds can actually extend out the length of the actual fund itself. So you could create sort of a series of almost zombie-like companies. And I wonder whether rather than being a popping of a bubble, it's like a hiss for like a long time.
Yeah, I guess it all depends on investor mentality, right? Like if suddenly there's a run, like people panic, much like they did in 2008, and that's part of the reason why AIG pretty much went away. If you have that type of withdrawal activity, that's a problem because you're going to work through your liquid stuff very quickly. Then you're into the illiquid stuff, and that's where the problem begins. Like, how do I get rid of this? Like, you're going to have to either gate it. And you know what gates do. Once a fund or anything gets gated, that creates more panic. Right. I mean, you saw what happened, with this BDC merger last week, right? Yeah. That was a disaster. that went away. You saw what happened. A major firm just had a CLO that got attached at the lower tranches, so they waived their fees to offset it, right? So you're on the verge of something happening.
So explain this. Everybody's super anxious. Yep. It seemed.
So Tom Lee, you guys know we react to plenty of Tom Lee videos on this channel, right? Tom Lee, what did I tell you was going to happen? I said, wait till things get shaky in the market, wait till the next bear market, Tom Lee's going to become so hated again. Sure enough, you know what I saw on X yesterday? Mad hate for Tom Lee. Oh, he's down $3.5 billion on his Ethereum position, all this stuff, like mad hate in regards to Tom Lee. I knew it. I knew that was going to happen, right? And the reason I knew that is because I started this channel in 2022. We started reacting to folks, right? And I watched Tom Lee, who people loved in kind of 2020, 2021, become very hated in 2022, right? And then yesterday, everybody's saying Tom Lee's the next Cathie Wood, right? And it's just like, whoo, like it's crazy. It switches quick, man. It switches really, really quick.
Yesterday morning, when we were on this broadcast, after the Nvidia earnings on Wednesday, that people were relieved. They thought, okay, maybe all of this hand-wringing was a little overboard. Yep. And then all of a sudden they said, maybe the hand-wringing is not overboard. What is happening here?
Well, so I watch the credit default swap markets very carefully, and you've watched what's happened with some of these hyperscalers, right? Oracle especially, their CDS is blown out from 40 to around 115.
That's been amazing.
120, right?
Jim
It's
Cramer
tripled.
did a really good job.
Yeah, Oracle's a mess. That stock is is 199. Oracle stock is a disaster zone. Look at this. Like, this is incredible, really. You know, to see this sort of downfall in a stock like Oracle that quickly, man. You know, look at that. It's down 42% now. Now we compare that versus S&P 500 under the same time and the QQQ under the same time. And look at, under the same time period, Oracle's down 42%. The Qs are actually up 1.7%. The S&P 500 is up 1.2%. And yet Oracle stock is just a disaster zone. Like, you can't find somebody to buy that stock. It's now 198. And even myself, I was kind of looking at it earlier today, and I was like, man, maybe I should take a flyer on Oracle. But I'm confused as well as about what actual future growth rates are. Their numbers have been really disappointing in terms of their actual numbers so far. They're guiding out for all these huge numbers. They're going to have a crazy depreciation situation coming for them. I mean, I don't know. Oracle's either going to be a great opportunity to buy in 26, or it's going to be like, you know, you're going to be thankful you stayed away. I'm still trying to figure out which of those it's going to be. We'll figure it out, though.
Job of laying all of this out.
Yeah, I mean, you really need to pay attention to those markets because they give you clues as to what's potentially happening. Like, it was always a mystery to me how, you know, a company like that took on all this debt and they added basically $150 billion in market capitalization to their stock while the CDS was starting to blow out.
Right.
Right now, they're starting to meet now. You know, the market cap's turning down, the CDS keeps going out. So I don't think it's the first of this you'll see. I think there's, you know, unfortunately, you know, when you build up this much debt and like you talked about, you know, this market's been in a straight line up for so long, people forget what it's like to lose money. And that creates an environment of no fear. And an environment with no fear is one you have to be very, very careful about, particularly when leverage ratios are high and when there's this much debt in the system.
So you think this is just the return of fear to the market, and that's what we're kind of watching?
I don't think there's much fear in the market at all, to be honest with you. I mean, people think like a 19 VIX is something crazy. I don't, that used to be normal.
Right.
You know, and now,
north of 25.
Yeah, well, it's just like, you know, people look at the high yield market and spreads are, you know, under 300 basis points. Those are right around all-time tight levels. My issue, I'm a fixed income manager, right? So I look at spread product like high yield investment grade, et cetera, collateralized CMOs, CLOs, you name it. They're all trading near record tight levels. So the amount you're getting paid to own this type of risk is basically the lowest it's ever been.
Can I ask you,
the math doesn't
can I
work.
ask you a crazy question?
Sure.
This may be a crazy question.
Before we go further here, how do I feel about his statement there about no fear in the market? He doesn't see any fear. Listen, 100% there's fear in this market. There's absolutely fear in this market. You and Nvidia just report as perfect of quarterly numbers as you could possibly imagine. With their beats, they raised their guidance in a substantial way, had a great conference call, basically said every key perfect thing you possibly could have said on that conference call. Then Jensen goes out there with Elon Musk in the Middle East, announced a new project. Then he dresses up in a suit and goes on Fox Business, goes on Bloomberg. He's talking with CNBC. He's talking to all the financial networks, telling them how, and yet the stock still can't go up. That's a fearful market. That's a market that's getting fearful. At the end, like, when you have perfection and it's still not enough, and you go on all the financial networks and you still can't get your stock price up, there's some fear out there. Palantir had another perfect earnings report. Unbelievable, right? Alex Karp swinging his sword around. The stock's down to 156. It was 200 plus not that long ago. And so, like, there's absolutely fear in the market. 100% there's fear in this market. Like, when you have companies reporting perfection, look at Nvidia. Like, Nvidia was nicely green earlier in the day, and now it's gone red. right? Now it's gone red. Why is that? You know why? People don't even want to hold stocks over the weekend because they think they might dump again this upcoming week. So like, I'm out. Like anybody that's a trader, they don't want to hold over the weekend because Monday there might be another big sell-off. And I'm not trying to get involved in that. So that's what you have going on now at this point in time, ladies and gentlemen. So I definitely disagree with him on fear. There's definitely fear in the market. Because it's not like it would be one thing if these stocks were going down, like Nvidia, Palantir, et cetera, and they were having bad earnings. Like they were missing numbers, they were missing guidance, et cetera. Okay, fair. Like, maybe they deserve to go down. These companies have, as they're saying every word perfect you could possibly imagine. Their numbers are perfect, and the stocks are going down regardless. That's a market that's getting pretty fearful.
Was it a mistake for Powell and the Fed to already lower rates the way they did this fall? Was that a mistake?
I don't like to second guess people. What I will say is...
No, but you can't. In retrospect, you can.
It didn't seem necessary. You and I talked about this last time I was on. I said, I don't know why they're bringing rates down. Remember I said last time we were on a few months ago, I said, next week they're going to lower rates. I don't think they should, but I know they're going to because there's a lot of political pressure there.
Well, that's what I was going to say. For the last year, there's been pressure from the president to lower interest rates. I mean, we've been told over and over that they need to lower interest rates, and now we're in this sort of uniquely...
And yet mortgage rates are stuck in this range, right in the mid-sixes, where they've been for a long, long time. So if the whole goal is to stimulate housing, through rock-bottom mortgage rates, I mean, the zero rates are not walking through that door anytime soon.
You just mentioned mortgages, and we haven't seen you since this was announced. What do you think of this 50-year mortgage idea?
I don't like it at all.
Because?
Because, a 50-year amortization schedule, I mean, think about that. You won't own the ability to own. The reason you want to own a home is to build equity.
Right. You won't even have any equity for the first 30 years.
That's exactly, and that's my point. It's like it's this mythical ownership, right, with a 50-year mortgage.
So it's really renting.
Yeah, I mean the concept of portable mortgages I understand because the big reason people don't want to move out of their houses, they have a very low mortgage rate and they can't get it now. And once they sell it, they got to get a higher one. So I understand the concept behind that. How it'll work, I'm not really sure.
Yeah, that could be messy from the lender side specifically. That'll change a lot. Time to buy the dip.
Looking for the opportunities amid all this bubble talk and, but the roller coaster that is the market right now.
Well, great to be on the show with you today, Contessa, especially on really where the Fed has been so kind to us. Great to hear from the New York Fed and from the Boston Fed today and see the market rally the way it is. We think, where we stand right now, it really is opportunity, not so much to buy the dips wildly, but rather to focus on the babies that get thrown out with the bathwater, those really great stocks that for the moment get thrown down like hot potatoes onto the floor by the traders, the short-term aggressive investors, on any excuse to sell without FOMO in a bull market that continues to appear to be very much intact. So we continue to like infotech, communication services. We like industrials. We like financials. And yes, we do like...
This is crazy to me, man. This is crazy to me. This is Oppenheimer's chief investment strategist. And look at this shirt he's in, man. Like, come on. And look at this background. Like, what are we talking about? The horrible lighting, and he's got a filing cabinet behind himself. Like, this is Oppenheimer's chief investment. Like, you would think they'd be like, let's get you like a professional setup and make sure you're wearing a suit or something like that. Like, heck, I even almost always wear suit jackets for my videos nowadays. Like, I'm wearing a hoodie today because it's raining out and I'm sick of all this rain in Vegas trying to change the vibe. But come on, man. Like, this is Oppenheimer's chief investment strategist.
Discretionary. We have been, for a long time, we're recommend cyclicals over defensives. That's worked out now for years, as well as for this year itself. We think volatility, part of the story. The big issue is, will the Fed indeed cut in December? We think it does 25 basis points. We call it another down payment by Jerome Powell to let both Wall Street and Main Street know that indeed the Fed is in the process of ending the Fed funds hike cycle that started in March of 2022. So far, what do we have? We have 3 cuts from last year, 2 cuts so far done this year, with 1 more likely to go. We can't help but think that this will, in effect, just lets people know that it may not be lowering rates as fast as many in the market want, particularly leverage players. And leverage players on Main Street, whether it's real estate or people just looking for lower mortgage rates. But we think overall the resilience in corporate earnings is as shown by the S&P 500, thus far remarkably good, powerful, with a domination of earnings growers versus I think just one or two negative earnings growers among the sectors, among the 11 sectors. And they're to be expected with energy based on the fact that we're awash oil around the world. But the rest is very good, and so we think stocks have time to move up and heal from the wobble that it had over the course of the last 10 days.
You mentioned consumer discretionary. In all of the focus on whether the Fed is going to cut or not cut, what gets lost is how that affects how consumers see the economy. The University of Michigan just out with its consumer sentiment index, which basically was in line with expectations, and they saw a little bit of a pop, just itty-bitty post-government shutdown when that ended. If you like all these sectors, info tech, communication services, industrials, financials, and consumer discretionary, what's there left not to like?
Well, I think, for example, we're not hot on real estate at this point. We think that's more a granular story where you want to look at the individual properties. We would also think that related to materials, not quite yet. It's beginning to warm up and gain some favor. I think earlier today it was seeing some favor. But we do think some that have been in the shadows sort of for a while here. Utilities are looking good. If the Fed is in the process of reducing interest rates, that trend should help reduce the typical what they call the bond market proxy of the utility stocks. When interest rates are high, their yields aren't as attractive typically. But this would be much more typical, would be much more attractive for their yields. In addition to that, the interim to long-term story for utilities, especially the regulated utilities of the S&P 500, looks good with prospects for improvement of the grid in the U.S. to provide all that electricity we're going to need.
So is it time to buy the dip, right? Technically, it's always time to buy the dip. Like I buy... The way I personally invest, here's how I do it, okay? I buy stocks every single Friday. Unless the market's closed on Friday, then I'll buy on Thursday. I buy in the public account, which is available for everybody in the private stock group to see every move I ever made in there. I buy in the Patreon portfolio every Friday. I buy in two of my private portfolios also every single Friday. That's non-negotiable. I don't care if the stock market's high, low, medium, if it's up a lot, if it's down a lot. That's happening every week regardless. There's always great opportunities. I don't care if we're in a bull market, bear market, kangaroo market, there's always going to be opportunities out there, okay? Always buying. Other than that, if the market gets very elevated, I start cashing up. So I'll put more of my income towards savings or CD accounts, something like that, or treasuries, than to put it into the market at a particular time. So a good example of that was certainly, really from this summer into really October. From summer to October, I was definitely building cash levels, right? Building cash. I was even selling some stocks and building cash that way. Stocks like Palantir, obviously, right? That got very, very richly valued, and a few others. And so building cash that way as well, right? Then we have some drama. Usually after the market gets very elevated and I build big cash levels, what happens is usually the market starts going through some trauma. It could be a pullback, could be a correction, or could be a full-blown crash, depending upon the circumstance, right? And then as that transpires, then I start to deploy that cash more heavily. And I start doing freak buys, I call them, where I'll come in with $40,000 in a day and buy. I'll come in with $60,000, $80,000 in a day and I'll buy, right? And so that's the way I play this game. I'm buying regardless every week. But if it's harder for me to find great deals and I'm not that enthusiastic, I'll build cash levels. And then as the market drops, I get more bullish and I deploy more money, and that's the way I play this game. And so it goes pretty well. Once again, make sure you take advantage of that 1000X sale we're going to have coming up here in 6 days from now. That will be pinned comment down there. It looks like we have 1,298 people ready to rock and roll. And when you get that sale, we will send you your Steel membership card for 4,000X. We'll send that to your house apartment, condo, wherever your dwelling is. And that's full access to the entire software suite and access to, I want to show you this right here, the education portion. This is amazing here. How to decode a balance sheet, income statement, cash flow, how to perform SWOT analysis, strong modes versus weak modes, how to value a dividend stock properly, how to value a growth stock properly, dividend investing, portfolio management, infinite money loop, that's a banger, basic option strategies, advanced option strategies, all that good stuff. You know, I put something on X yesterday, and I don't usually make short-term calls on the stock market or stocks. But yesterday I posted on X, I said, be on the lookout for a gapping crap on Nvidia. And this was at a time period when like people are like, what? You're crazy. Like Nvidia's going up, stock's up nicely after hours. The earnings are amazing. The guidance is amazing. The conference call is amazing. And they're a guy that doesn't usually make short-term calls in the market. It's basically telling you look for a gap and crap. And sure enough, it crapped, right? What happened? Like how did I have the confidence to go out there and say something like that? We'll speak about that in this video here today, okay? From there, I want to do a lot of stock talk. I'm going to take you through big tech, talk about the stocks I think are most interesting here. I'm going to take you through my possible buys watch list, what stocks are up next for me to buy, all that good stuff. Then I'm going to share with you also what stocks I actually bought today. I bought over $40,000 of stocks just shortly before I started recording this video here. I'll share what those stocks are, why I bought those stocks. From there, we'll go ahead and react to this video, which is very important. This is the most underrated subject in the stock market right now, is around depreciation of these chips all these big tech companies are ordering. So important. I spoke about it extensively on the main channel last night. I want to go ahead and react to that. And then we'll react to Ray Dalio, which has a very interesting stance. He says, we're definitely in a bubble, but that doesn't mean you should sell. That should be a very interesting one to react to. A lot to go through. I hope you guys appreciate me covering all this for you and trying to get this stuff out in a timely fashion. I appreciate y'all for joining me. Only one thing only I need from you. Just hit that little thumbs up button, that like button. That's all I need from you, okay? If you want to be subscribed here, definitely subscribe. I'm going to try to keep you guys up in the loop as all this drama unfolds here over the next few weeks, okay? Also, pinned comment down there is going to be to our massive Black Friday sale. You need this sale. It is we're going to basically send out the first emails and text messages on Thanksgiving night, and then it'll be live all of Black Friday. And so and then the sale will be over essentially. So that will be the pinned comment down there. Enter in your name, your email. If you want to receive it via text, we can send it over via text. We're going to have a 1-month sale and a 3-year sale. So I know there's a lot of people from a lot of different backgrounds that watch my videos. Some of you guys have your first few $1,000 invested in the market, the 1-month deal will be for you, right? Either you guys have more money than you don't know what to do with, right? And that will be, the 3-year deal might be a better option for you. You'll save more money over time, okay? We have 960 people now signed up for that sale. So I'm very excited for all you guys, and I'm sure we'll be at 2,000 plus before you know it. Just last night, right before I went to bed, I checked and we were at 777. So yeah, that was a pretty cool number. Alrighty guys, so what's going on here? Let's talk stocks, let's talk market, let's talk the best opportunities in the market. Let's talk about what's actually going on. Listen, for me to make a short-term call on a stock, I have to be pretty dang confident because I'm a long-term investor, but I've been in the market 17 years and I've seen every twist, turn, everything this market could throw at you. I've seen it. There's nothing that could really happen now that I will like, oh, I've never seen this before. Like everything, like, crashes, corrections, time periods when you think the market should be going up and it goes down, time periods when the market's going down and you think it should be going up, like vice versa. Like when you're in this game long enough, you're going to be like, I've seen this show before. So Nvidia, they come out with the most amazing report you could possibly come out with. They destroy the revenue, EPS, the guidance is way ahead of everybody on Wall Street, even the bulls, right? Phenomenal commentary, talking about demands, insane, blah, 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 right? And yet, what does it have to show for it? It's down to 181 after hours, right? And so how do I have confidence to make a call like that? Well, a few things, right? I posted this also. I think this was even more important than to be on the lookout for the gap and crap. I said, the max pain, by the way, my X is always linked in the description if you guys ever want to follow me on there. I said the max pain for the stock market would be if Nvidia loses its gains during the trading day tomorrow or by Friday option expirations. The longs and shorts would lose. Plus, it would hurt bull sentiment. That was the worst thing that could happen, right? Is Nvidia could gap and crap. And many times the stock market, especially when the stock market's entering a nasty mode, which is what we've now entered, it wants to cause maximum damage out there. So basically, everybody was expecting at least a 7% move on Nvidia stock. So everybody was, buying calls, buying puts, expecting at least a 7% move. So if Nvidia doesn't move at least 7% to the downside or upside, all those people are going to get screwed in the end. They're all going to end up losing all their money on that, right? That's a max pain situation. Additionally, the bulls were so hyped up, and I was looking at X yesterday, right? And even me coming out and saying, be on the lookout for a gap and crap, people were attacking me left and right. It was insane just for saying that. And I'm like, guys, like, you know, I'm just trying to put you on some game here. Like, don't attack the guy who's trying to teach you. Like, you know, it's like somebody's trying to teach you 2 + 2, and you're like, oh, you're evil. And it's like, dude, what is going on here, right? When we're talking about maximum pain for a stock market, like the worst thing you could do right now is, the most damaging thing is have a stock like Nvidia report perfection, right? And have the stock go down. Then does that really kill bull sentiment? Because bulls are looking out there and like, if they came in with perfection and their stock goes down, well, what do you have to do to have your stock go up in this market, right? And you're looking at other stocks like Oracle, all of its gains that stock had, it's now lost those gains, right? Now at this point in time, it's lost everything, and now it's way lower than even before the OpenAI announcement. Amazon, that stock went up huge after earnings. It's lost everything and then some now at this point in time. This is like psychological warfare going on out there where, you know, just like damage, and everybody that, you know, was so excited about stocks only going up is like, oh boy, okay, things are kind of flipping. So that's why I made that call last night, which once again, I do not make many calls on the short term of the stock market. So if I do, it's because I'm pretty darn confident with something that's going on out there at that particular time. Okay. Now let's talk some stocks. Okay. So when we look at the Qs now at this point in time, the Qs are down 7.6%. Very important everybody understands this before we start talking about a bunch of stocks. Listen, if you've been watching my content all year, what have I been telling you this whole dang year, at least the last 6+ months? This is 2018, right? In the whole time I've explained, this is just an inverse 2018. 2018, you had a small drop at the beginning of the year, huge drop at the end of the year. We're having an inverse now. We had a huge drop at the beginning of the year, a smaller drop at the end of the year. At least that's what I foresee, right? Meaning I expect the NASDAQ to go down 10 to 15% before this is all said and done. Right now we're at 7.7% roughly, right? So we're over halfway there in regards to this matter. And so this is exactly what I thought would play out, and it's playing out. The fact that people didn't see this coming, I'm like, you know, like, you should have seen this one coming if you have a lot of experience in the market. If you're brand new to the market, like, I understand, like, you know, trying to understand like why the market would go down at a particular time, I get it. But if you've been in this game for a long time, you know, I think you could kind of see this one coming. But even I'll be honest with you guys, even a lot of people that do have a lot of experience in the market, even a lot of them still didn't see this one coming. And I'm like, guys, like, everything's lining up just like 2018. We're just an inverse in terms of the size of the drop at the particular year, but I'm like, everything's lining up here. And so that's exactly what we have playing out now at this point in time. So MU, this one's sinking rapidly. This stock was touching 250. It seemed like just last week. I swear, like last week, this stock was touching 250. Was it not? Let's look here. November 10th, the stock's 250. It's lost 20% of its value like that, right? MU, great company. Memory demand is insanely high. Oh my gosh, it was even higher. Just on the November 17th. No way. November 17th, it was just a few days ago. That's crazy. Just in a few days, it's November 20th right now. So 3 days ago, 4 days, like what? That's insane that MU's lost that much value. Here's the thing you got to understand about MU. Memory demand is insane right now, and that's not going to stop. Nvidia needs all this memory, AMD needs all this memory, and like they're going to keep selling massive amounts of orders. And so like MU's in a sweet spot, but the stock had ran a lot. If we pull up a 1 year on MU, look at the 1 year on MU. It's up 107%. So when you make that sort of insane move, you're going to eventually be due for a big pullback. And that's exactly what we see now at this point in time in regards to MU. You look on a 1 month basis, it's only actually down 2%. It's just down off a cliff from where it was just a few trading days ago. That's insane, man. What a drop. Now, if we look out here, Palo Alto Network's getting hit a bit. AMD's another one that's gotten hit hard the past few trading days. Like, look at this. This is just since that November 17th as well. Down about 15%. Palantir's starting to really get hammered now at this point in time. Another telltale sign about this Nvidia situation, right? Because you looked at the Nvidia earnings and it's perfection. First off, shouldn't we all have expected perfection from Nvidia? We've got confirmation from every big tech company out there saying they're ordering as many of their chips as they can possibly get. No one should have expected anything other than perfection out of Nvidia. But another way you could have gotten a signal that the stock might go into trouble here in regards to Nvidia was look at Palantir. What happened with Palantir? Palantir reported a perfect quarter. They reported the rule of 40, they took it to what, 114% or whatever, like a number like it's just, we don't know if we've ever seen a company do numbers like this before. It's just ridiculous. Palantir reported perfection on perfection. And what does the stock have to show for it? The stock's down 23+% since those, right after those earnings. That's a little sign of like, hey, the market wants to go lower right now. Doesn't matter what you report. There's certain time periods, it doesn't matter what you report. You can report crap numbers. If the market's going up, your stock's going up. We watched that actually play out because the market bottomed Q4 2022 and then started moving up heavy. Big tech earnings were still trash actually at the beginning of 2023. They were not good. They were not good. But those stocks were already starting to move heavy because the market's like, it's time to move. We're moving up. Everything starts getting pushed up, right? And people start looking at it like a bottom and things are going to get better in the future. Right now, we have an opposite situation. It doesn't matter how good of numbers you report right now. The market wants to go lower. It's taking everything lower. Doesn't matter if you're Amazon. Doesn't matter how much you beat your earnings per share or revenue, anything. If lower is where we're going, lower is where we're going short term, right? That just is what it is. And what do you have to do as a long-term investor in that situation? Absolutely nothing except buy. You hold, you buy, play that game. Don't play the game of trying to get out because you're like, well, the market wants to go lower, go lower. Nah. Because you're not going to know when to get out. You're not going to know when to get back in. You're going to get hit by taxes all over the place. You're going to be messed up mentally. No, you don't play that game, okay? Just understand that's part of the game. No different than if you play a game of basketball, right? The other team's going to score some points. That's fine. That's what happens. Like, you got to expect that. So if you're a long-term investor, like sometimes the market's just going to go lower, you hold through that and you buy. And whatever it's going to be, because you don't know when the bottom's going to be. The bottom could be today. It could be a week from now. It could be a month from now. It could be 2 months from now. It could be 6 months from now. It could be 12 months from now. You have no clue. And so don't try to think like, oh, I'm going to outsmart the market and get out and get back in and get back. No. Believe me. Some of the most intelligent people in the world have tried that and failed miserably again and again and again and again. Oracle. This is unbelievable what has happened to Oracle because we go back to that big announcement, the OpenAI announcement, right? If we look at that stock before the announcement came out, it's now down 4% since before the announcement. So basically they're looking at this as like bad news and that stock spikes massively, right? Spikes massively. And now since that time period, the stock's down 37.6%. Unbelievable. And this was a big OpenAI announcement they had. Like, that's incredible. Nvidia. So Nvidia, obviously from where it was just a few weeks ago, it's down quite a bit. But on a 1 month, it's flat, right? On a 1 month, it's flat. Nothing crazy there. Stock's down about 14% from highs. So, Nvidia's gotten hit, but it hasn't gotten hit that hard, to be fair. Amazon, look at this. It has a massive spike on earnings. The earnings were amazing. AWS growth. Whoa, we're back, baby. 20% plus revenue growth of our AWS is back. And look at the stock since after those earnings, down 14%. It lost everything, right? Just gave it away. So Salesforce, a really hated stock in the market right now. Even if we pull up a 1 year on this one, look at that, down 30%. A year to date on this one, down 32%. Man, no one wants that one. Now let's go ahead and pull up my current stocks and positions here. And so if we look at my positions, I have actually a few that are green here today. Oh, the planet's green, that's funny. Tesla, which is my Tesla hedge, that one's green here today. By the way, let me say, when am I thinking about taking that Tesla hedge and cashing that for a profit? I think sooner rather than later in regards to that matter. I'm just trying to figure out I kind of wanted to hold that into next year. But if this market keeps going down and a lot of these other stocks keep emerging as opportunities, that's $52,000 right now. If that keeps appreciating, next thing you know, it'll be 55, it'll be 60,000, 70,000. And at some point in time, I'm going to be like, I got to put that money into long positions in the public account, right? So yeah, and I do have some of that in some of my private portfolios as well. So, Tesla should be getting hit harder. That's the problem, though. That stock should be getting hit harder. It might be a lagger in terms of when it actually starts getting hit really hard, because I don't think the major damage has even come in Tesla yet. Estee Lauder's green, great turnaround play there. Shopify is hardly red. American Express is hardly red. So there's some stocks that are actually faring pretty well. Wynn Resorts is faring pretty well, right? Which this shows you. What does this show you? The main thing this shows you is today's sell-off is mainly tech fears, right? And growth stock fears. Because you're looking in to see some of these stocks like an Estee Lauder green, an American Express only down slightly, a Wynn Resorts, a resort company. Like if people were really worried about the economy, right? I think Estee Lauder would be down big today. I think American Express would be down big today. I think Wynn Resorts would be down big today. I think Revolve is only down 0.8%. Like I think Revolve would be down massively today. I think if people were really worried about the economy, Nike would be down huge today. It's down 1%. It's mainly, look at my worst stock today. It's self-explanatory. AMD down 6% here today, right? There's just so much negativity really in the chip space right now and big tech and spending and all that good stuff, right? Now let's pull up my possible buys watch list, which I need to rename this list. How do I rename this list? Let's see. Rename. There we go. No, not this list. I didn't want to rename this one. Oh my gosh. I want to rename my possible buys. I need to make this 2026 possible buys. So there we go. All right. 2026 possible buys. Okay. So what do we have here for this list? So this is perfect. Bath and Body Works is going down like off a cliff. That's perfect. I want to start a position of that in 2026, likely in January. So this is like the best case scenario I could possibly ask for in regards to Bath and Body Works. Keep going down all the way to Chinatown, baby. Like if that stock went down to $12, $14, I would not be mad. This is like literally as good as it gets in regards to that matter. RH continues to get hit. I want to see that stock go under 100. Cava continues to get hit. I want to see that stock go under 40. Those are three stocks I'm looking at for 2026. Whirlpool's another one, but look at Whirlpool. Whirlpool holding strong today. Whirlpool's only down 0.1%. Oh, man. And that's with, like, that shows you there's not as much fear really about the economy. It's about big tech and about these chips and those sorts of things, right? So, but man, I love Bath & Body Works being down off a cliff here today. That is so perfect. But yeah, there's a lot of steel deals, and we'll go into my buys in just a moment. So, housing stocks, some damage, but it's not that bad for housing stocks, right? Now, if we look at my potential hedges for 2025, Hood's down huge. Understandably, Hood's down huge. You have Bitcoin going down substantially, right? Additionally, listen, ladies and gentlemen, listen. When you have damage in the stock market, okay, it's very important everybody understands this. Some retail investors leave the market and they don't come back for years, okay? Because they like, I lost $5,000, $10,000. Stock market's a scam. 20,000, 50,000, whatever the amount is, right? Stock market's a scam. So leave it for years. Some hold through, right, and make it out to the other side and go on to prosper over time. But the issue is a lot of those longer term investors, some of them are with Robinhood, but a lot of them are with like Fidelity Investments like myself, or with Charles Schwab, or with other like bigger platforms that aren't as focused on like trading and options and those sorts of things, right? And so Hood is usually one of the biggest beneficiaries when the stock market's going crazy, when Bitcoin's going crazy. And they're actually one of the companies that get hit the most when Bitcoin's going down, when the stock market's going down, because people leave the market and like, this is a scam. You know, Bitcoin, I put it in 100K and now it's 86K, like sell it, I'm leaving, I'm done with this crap, right? And so then Robinhood's assets under management goes down substantially as a whole situation, right? And their business weakens considerably, and the business can go from unbelievable growth rates where people are like, oh my gosh, they're growing revenue at 40%. They're growing net income at 60%, whatever, right? To suddenly a year later, they're like, have flat numbers or down numbers. Like, what? How could this happen? Send the market down a bunch, and a bunch of people are going to dip on the market, right? Think it's a scam, and they're going to leave, and they're going to delete their Robinhood accounts and all that sort of stuff. Like, that's just what happens, right? And the strong survive. They make it out to the other side, and they make more money than they ever dreamt. We lost a lot of people in 2022, did we not? We lost a lot of people. You know why? The NASDAQ went down 37% from Q4 2021 peak to Q4 2022 bottom, 37% down. We lost So many investors. Well, I don't know if I could call them investors, traders, people that were in the market. It was like a ghost town, right? Complete ghost town. People are like, screw the stock market. It's a scam. Like, this is bad. And they all left at the worst time. They should have been buying that 2022, crash like nobody's business. Like, how often you get the NASDAQ go down 37% in a year? Like, that almost never happens. The only time I could think of that happening was the great financial crisis and the tech bubble pop. It almost never happens. So you're getting like a once in every 10, 15 year opportunity. You better take advantage. And what happened was people left the market in mass. And what happened to Robinhood's user base? Boop. What happened to Robinhood's revenue? Everything across the board, boop, 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 all went bad. So unfortunately, I wish it wasn't like that, but it is like that. So we could wish things were the other way. And it's like, we wish like everybody stayed invested and bought these crashes and corrections that happen in the market. But a lot of times people don't. They dip, man. And it's sad, but it does happen. And you got to understand that for somebody like Robinhood, where all of a sudden their growth could slow substantially. People are like, what happened? That's how it happened, right? Same thing with Coinbase, just they're obviously crypto exposed there, right? HIMS is a stock that, man, has that one gotten hit hard. Duolingo continues to get hammered. Those are retail trader type stocks, right? HIMS, Duolingo, even Hood, Coinbase. These are stocks like retail traders love, right? And they just continue to get damaged. And remember, margin went out of control, right? Margin's been out of control. If you've looked at the latest margin numbers, they're out of control. People are, like 1.2 trillion or something insane with the latest reading from what I remember in regards to margin outstanding. As bad as it hurts, you gotta destroy everybody, so you destroy the margin. It's just what has to happen, because it never fails. Like, market keeps going up. Retail traders start going crazy on margin, right? Thinking it's only blue skies out ahead, and man, they set themselves up for a bad situation. Next thing you know, margin call, left and right. And then, everybody's liquidating their margin. Some people get really discouraged because they're on margin. Like, I was even reading a comment today. Somebody, I think it was on X, I was reading this, there's a lot of gamblers on X. Somebody's like, I'm so done with this market. Why did I even give it a chance? Because they played basically a bunch of short-term call options on Nvidia. And they're like, because they're like, earnings are going to be good, I'm going to play a bunch of call options. So they did that, right? And then they're crying because they lost all their money. And it's like, dude, everybody and the grandma knew Nvidia earnings were going to be amazing. The guidance was good. Everybody knew that. And the fact that you get noobs in the market that will play this game of like trying to gamble money on options. And it's like, you don't even understand like base fundamentals of the market. How do you think this is going to end? Oh boy. It's unbelievable, man. It's unbelievable. But I'm not even shocked by it anymore. I've been on YouTube now for almost a decade, right? It started in 2016. I started posting. And I went to more stock market heavy in 2017. So, nearly a decade on this platform and on social media and seeing the stuff and the cycles. And it's just like, come on, man. Come on. Okay, so what are the stocks I bought here today? First off, why did I buy before we get into, the stocks I bought? If I think the NASDAQ is going to go down 10 to 15%, why would I step in and buy $40,000 plus of stocks today when the NASDAQ's only down 7.5%? And I think that's a fair question. Well, just because I think the NASDAQ's going to go down 10 to 15%, and that's what my intuition's telling me in my 17 years experience, that does not mean that's going to happen. Just because I think it's going to happen doesn't mean it's going to happen. The market could bottom today, next week, next month. Like, there's a million things that could happen. It could go down 50%. There's a million things that could happen. You can never bet on absolutes in the market. Never. You have to take a range of outcomes into consideration. And so under my range of outcomes here, there's a possibility that the market doesn't go down much further. And buying the stocks I bought today aren't going to go much lower, if at all lower from where they are, right? That's a possibility. And there's also a possibility it gets a lot worse. But the moral of the story is, if I see stocks at great prices, where I'm going to make a ton of money on these stocks over the next 4 to 5 years, I have to buy. And I bought a lot of stocks today that if we look out 2, 3, 4 years from now, I'm going to have made a ton of money in them. Will I make money in these stocks over the next 3 weeks? The next 3 months? I don't know. Who knows? Will I make a lot of money in these stocks that I bought today over the next 3 years? I think there's a pretty high probability of that. And so, okay, so what did I buy here today? Well, I posted this inside my private stock group today. I said since the abnormal big buy day in a private portfolio of mine, I figured I'd let you guys know. So let's see. I bought 30 shares of Amazing's on 218. A lot of fears around the depreciation. We're about to get into that subject, right? And I spoke about that extensively on the main channel last night and explained that subject, right? Amazon's not a stock I worry about in regards to depreciation because this has always been an asset-heavy business. Nothing's changing with Amazon. They're just asset-heavy. Like, that's what they've been. Their margins are low. Their net margins are trash. That's how it's been for the longest time, since the 90s. Like, that's how it's always been. And so I understand other people worrying that might own typically more asset-light businesses like Microsoft or Google or, just other companies in general that maybe are more asset light, and even Meta, right, going more asset heavy. I understand those people worrying about their margins and profitability in the future and things like that. Amazon, I'm not worried at all. Like, that's what this company's always been, asset heavy. Okay. Salesforce, I bought $4,000 worth of Salesforce here today. Great buying opportunity in my opinion. In regards to Salesforce, I understand it's a very hated stock right now. No one wants a piece of that stock, but man, it is just a steal deal in my opinion, an absolute steal deal in my opinion, and one of the best companies really in the market you could own over time. I understand the stock has sucked the last 5 years, but look at it the last 20 years. Look at it the last 25 years, right? If we look at Adobe, man, is that one undervalued. I love the acquisition they just completed, so I came in with a pretty big buy today of Adobe, almost $8,200 buy there. Celsius Holdings, that one's a steal deal, about a $4,000 buy there for Celsius. Got it just under $40 a share. Really the most attractive pricing we've seen on Celsius in quite a long time. Elf, another one, like this is the most attractive pricing we've gotten on Elf. And this is exactly what I would have expected from a lot of these stocks, right? Like Elf, Celsius, these sorts of stocks, right? I would have expected them to get hit again late in this year, just like they got hit early in the year. The thing is, I don't think any of these stocks are seeing the prices we saw earlier in the year when you had the big downdraft in the market. That's when Elf went to $49. Do I think Elf's going to $49? I don't. I just don't. Do I think Celsius in those lows was like what, $24, $25, $22, I think it was. I think it actually got down to 19 or something like that. Do I think Celsius going to 20? I don't. I think Celsius, Elf, stocks like that are much closer to the bottom than they are to the top. And so I think those stocks are probably within a few percentage of bottoming. That's my personal opinion. I could be wrong on that. Maybe Elf goes down to 49 where it was in, the April drama. Maybe Celsius goes down to $20. I don't think that's going to happen. I just don't see that happening. And so really, regardless of what happens with the market here, that is what it is. So I think I'm getting close to the bottom on these as far as the bottom for the late year bottom. Okay. Obviously the earlier bottom was, many months ago back in April. You missed that one. Cheesecake Factory. Well, some of you guys got that one. Cheesecake Factory 43 on this one. That one, I'm trying to remember where cake went to at the bottom of April. I can't even remember. There's so many stocks were moving so insane at that particular time. Cake got down to right around where we're actually at right now, right? And that's a sector just no one wants a piece of right now. Just everybody's been selling that sector nonstop. And so I'm here to step in and be like, give me, at the end of the day, we know the consumer numbers aren't going to be good in the short term, the very short term, like this quarter, they'll report in January. None of the consumer numbers are going to be good in the next 3 to 6 months. And the reason being is if you look at Target numbers, their revenues were down, right? If you look at all the restaurants, if you look at Starbucks, Chipotle, all those companies, like all their earnings were bad. Guidance wasn't good. Even a company like Cava. Nothing's good with the consumer right now. Bath and Body Works tanked off a cliff. They missed their revenue and EPS expectations. So the consumer, don't expect anything from the consumer in the next 3 to 6 months. I'm actually bullish on the consumer as we get through 2026. I think the big, beautiful bill helps out. I think if they do those stimulus checks out will help out. I think the lack of inflation is going to really help out in regards to a lot of those sorts of matters. And so we'll see how much actually gets passed on to the consumer in regards to the whole tariff situation. But the moral of the story is here, that's a great deal. Like, I don't know what else to say. Like, it's just a great deal. Like, I'm like, give me cake at this price. Like, I love cake at 43. Like, come on, man. Thank you very much. AMD, this might surprise some people because I already have AMD as such a big position in different portfolios. Like, I own well over 7 figures of AMD stock. I don't even think I've ever disclosed that before, but it's a lot. I mean, I don't think people understand how many AMD shares I was buying the first 6 months of this year. I was loading the boat. That's another one of those stocks. Like, this is kind of what I expected. Like, AMD wasn't going to just go straight to the moon. Like, you were going to get hit short term, right? Before we start the next big cycle up. And the next big cycle is going to take AMD to, that 325 level, in my opinion. And so short term pain, is that stock going back to $80 where it was in April? Absolutely not. It's not even getting anywhere close to that. And so AMD, you understand, we haven't even started the party yet on AMD. I understand the stock price party has started, but the real party hasn't even started with AMD. The real party for AMD starts in the second half of next year when the 450 series goes into production. That's a chip everybody wants. That's when AMD's revenues explode higher. That's when their margins explode higher, when their profitability explodes higher. That's when the real party starts. Like, we're just setting up for the party right now. Like, we're just getting the drinks ready. The bartender's just getting everything ready. The party has it. Like, I hope everybody understands that. And that's going to be a multi-year party. Like, we're going to party in 26, 27, 28. And then the party will be over eventually. Maybe that's 29. Maybe that's 2030. And when I say over, it doesn't mean AMD's done as a company at that point in time. It's just like that insane growth cycle we're going to go through starting in the second half of next year. I mean, we've already started a major growth cycle, right? The growth rates have already started to skyrocket. It's just we're going to take it to another level that I don't think anybody's prepared for starting in the second half of next year. And that's when, man, we're going to have some fun, baby. Okay, so let's talk about some serious subjects here. If we didn't already talk about enough serious subjects, let's talk about the depreciation situation, which is very serious. And let's talk about Dalio.
Are actually useful, adding some fuel to those bubble fears. Nvidia's CFO weighed in on that last night, saying that chips they shipped 6 years ago are still
963 we're up to
today.
963.
It's a good topic for our
ready for
in today's Tech Check. Hey,
Pin common, baby.
Hey, good morning, Carl. So that's right. CFO Colette Kress, she tried to put the depreciation debate to bed, but she may have actually raised even bigger questions. She essentially said that Nvidia chips, they last longer than most people assume, 6 years, and still at full utilization thanks to its CUDA software. But what does full utilization actually mean? Running isn't the same as creating economic value, and that is where Michael Burry comes back in, throwing cold water on the whole idea. He posted on X that extending useful life confuses physical utilization with value creation. He likens the A100 chips to airlines that keep old planes around for holiday overflow. Yes, they fly and they're full, but they're only marginally profitable, and they're not worth very much at all. Now, Jensen Huang has basically admitted this. He said last March that you can keep old GPUs working, but they become almost impossible to sell once the next model shows up. This was at GTC. He said that Blackwell, its latest generation, is so much more powerful than Hopper, the previous generation, that, quote, you couldn't give Hoppers away. He said there's only a few circumstances where they're even fine. That's the word he used, fine. Now, in the current moment where supply is tight, old chips, they will get used. But if that imbalance changes, and this is sort of the question on everyone's minds, does that value drop very quickly as well? The risk for investors is this uncertainty. If you do not know how long these chips stay economically valuable, you cannot properly model CapEx or margins. You can't model the AI cycle with confidence. Meanwhile, guys, I know we talked about Google's TPUs yesterday as a longer-term alternative to NVIDIA GPUs. If the market is struggling to understand the economic life of NVIDIA hardware, Google's bet is just to build its own. It just dropped Nano Banana Pro this morning, its new image model, powered by Gemini 3, which runs on TPUs, not GPU infrastructure. Investors, they continue to pile into this trade, this vertical integration story. Google shares still up nearly 1% today as the tech trade overall sort of softens.
Yeah, that's a great example. But you're right, the conversation's not going away. It's definitely feeding the short discussion. And that's not even mentioning some of the innovation that we're getting out of the likes of China, which continue to be just a series of like DeepSeek echoes, although not as noticed now.
one of my favorite topics and biggest questions amid all of this. How do the Chinese get away with spending like so much less than American model builders? I mean, it's like a 9-to-1 ratio. We're spending on GPUs, on all of this infrastructure, and the Chinese are able to create comparable open source models, in some cases beating on some benchmarks. How does that all sort of pan out? And that's another bigger question for sort of the bubble anxieties that I think is only going to get louder and raises questions also about the GPU usage.
For sure. Deirdre, thank you. Deirdre Bosa on Tech Check today.
Yeah, and so how do you look at something like that, what we just heard there, from the perspective of Nvidia and also the perspective of all these big tech companies, especially around the talk of, these chips are only really super useful for the first 2 years, and China's being able to do this stuff for much cheaper. How do you look at all this? First, from Nvidia's perspective, big risk, right? If these big tech companies over the next couple of years are able to find ways to do what they need to do for cheaper, it's a risk for Nvidia, right? Part of that's going to be using AMD. AMD is not nearly as high margin as Nvidia is, and so AMD is going to be undercutting Nvidia's price points, right? That's a big risk. And Nvidia hasn't even had to face that risk. They just finally start to face that risk in the second half of next year. Additionally, if just in general, like these companies find more efficient ways, and that means they don't need to place as big of orders for Nvidia chips in 2027, 2028, right? Which is a big risk. So it's a big risk to Nvidia, and it should be taken very, very serious. What about for the big tech companies? The way I look at this, nothing but opportunity. Because there's a high probability, these companies have a lot of very intelligent people working for them, right? Very high probability over the next year to year and a half, they're going to find ways to do what they need to do for cheaper, right? And so I think these companies could start flatlining their CapEx or maybe even slightly bringing down CapEx in 2027, 2028. I don't think these companies are going to have massive increases in 27, 28. I think they'll have decent increases again in 26, but I don't think they're going to be skyrocketing that CapEx in any major way in 27, 28. One, they can't afford it. They can't afford it. They're already going to be spending so much more in 26 and 25, which their numbers are already insane. And a lot of these companies are now spending more in a quarter than they make in profits. So it's totally not sustainable for them to spend aggressively 27, 28. And, we always make fun of the Chinese for copying American companies. This might be a situation of the American companies actually copy the Chinese and be like, hey, you guys doing that for so cheap over there, right? And so something to keep in mind there, and it's a big risk for Nvidia, but it's a big opportunity for the big tech companies because they can't be dealing with all this depreciation. Ray Dalio.
Morning to you, sir.
Morning.
So you've been providing lessons for us for a very long time about economic cycles and where we are and what's going on. The big question in the market right now, because we're looking at Nvidia this morning, and I think
before we go further here, let me just say this for anybody that's not aware of Ray Dalio, right? Obviously, legendary investor over time at the Bridgewater Fund, but I will say this: Ray Dalio's leaned very, very bearish for years. Okay, so just understand. When he sounds bearish, the man, it's not like this is some new thing. He's like, if you've been following Ray Dalio the last 5, 7, 10 years, like, man's sound is so bearish over the years.
Waking up thinking, where's the market headed next, has been this question of an AI bubble. And curious where you ultimately come down. Are you with Jensen Huang, who says he doesn't see it that way, or do you see something else?
There's definitely a bubble in markets. Bubbles, what is a bubble? Right?
Okay, what is a bubble?
What is a bubble? A bubble is that there's a lot of creation of wealth from various ways, such as you decide that you're going to have sell $50 billion worth of stock and value it at $1 trillion, or you have multiples like that, and then you create the wealth that way. And then the question with all this wealth relative to money is who needs the money. So it's a matter of who the buyers and sellers are. For example, if we had a wealth tax, right, or if you had a tightening of monetary policy, then there has to be the selling of those assets. So in order to pay those things. So there's a mechanics of who owns it, is it over-owned, and so on. It's not the long-term duration of the earnings. So you think about it, isn't it interesting that we have such a short-term reaction? It's great that what the results are, but this is it's valued as a long-duration asset. So for 25 years, the next 25 years, it's very unknown. We don't know what's going to happen, and bubbles don't happen because of good estimates of what in the future. It happens
to push back against Ray Dalio, Nvidia's stock is not valued on what they're going to be bringing in for earnings over the next 25 years. No stock in the market is. People are thinking about it in the context of what is this company going to be bringing in over the next few years, right? And what am I paying for that? And is this business model sustainable over the longer term, right? And with Nvidia, there's like a question. It's like, okay, there's this insane demand short term for their chips, right? We know that. Is there still going to be this insane demand? Are they going to be able to get these sorts of price points 5 years from now, 10 years from now? That's a question, right? And, I can't even confidently say one way or another. So that's a fair question.
Of the need for cash. Do you sell that asset? Do you have to sell that asset for cash for some reason?
Well, that's the question, though.
So your book, I thought, did such a good example. I mean, I thought, by the way, your book is fabulous.
Oh, thank you.
But you take the 1929, and then you say, what made it go up and what made it go down? And that dynamic is the way bubbles work, right? And so if you take who has exposures, how much leverage is used, and so on, this is about 80% into a bubble that was 100% would have been 1929 and 2000.
So how much leverage do you think is supporting all of this? Because we were talking to Partenovelis in the last hour, and she was explaining this idea that Jensen Huang doesn't see a lot of the transactions that he's been doing. We've talked about these circular transactions where he's effectively taking an equity stake in some business, and that business is then committing to buy his chips, if you will.
Yeah.
A form of vendor financing with sort of a equity overlay, maybe, is the way to think about it. Do you look at that and say that's a problem? It's not a problem? Should we think about vendor financing in a different way? That was something that got a lot of the fiber guys in trouble in the late 90s, for example.
Yeah, I think it's an issue, but I don't think it's the main issue. I think the real issue is who owns the stock.
Okay.
Is it in strong hands? Not just one stock.
Right.
Isn't it amazing we're talking about one stock for the stock market bubble and we're talking about for the economy bubble? So you have such a small percentage of the economy, such a small percentage of the American population in terms of wealth and so on, concentrated, and everybody in it and in a leveraged way. In various ways, it has leverage.
What are strong hands? How would you define that?
Weak hands would be the public.
So retail investors are weak hands.
Right.
Strong hands are the owners of these companies.
Right. In other words, strong hands is that they primarily invest their own money. You don't have public, right? The weak hands is largely, let's say, a leveraged public. And all united about that. That's one of the key ingredients of a bubble. Right. So it's not just pricing, because we have to find out. Your book did such a great job of looking at the wonderful companies.
Real quick here, I think I got to push back against Ray Dalio again. I think this is very important to say this. Okay, listen. You have the public, retail investors, that you have a segment that is typical. You would put those people into that category. Gamblers, don't know what they're doing, weak hands, blah, 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 right? But nowadays, you have a very strong group of long-term investors that are actually putting in the work, doing the research, right? Running their numbers, using 1000xstocks.com to run their projections, all that good stuff, right? And they're two very different groups. And so I don't want us to all to group like, all a retail. I'm a retail investor, right? Been in this game 17 years. I do all my research, do all my work, made insane money over the years, right? Became obviously very lucky to join the 1%, okay? Did all that stuff. Beautiful. From a kid cleaning dishes in the back of Einstein Bagels to what we are at now, right? Great. I'm a segment, okay? And there's another segment of people that don't know what they're doing. They don't put any work. They're just gambling money around. They're just throwing money, whatever, right? They're margining out. They're doing just silly stuff. They're playing Nvidia call options because Nvidia's earnings are going to be good. So that means the stock's going to explode higher, right? All that good stuff. So let's not put those two groups together. It used to be just everybody was in that group, but now it's a very different group. A lot of you guys, you don't really care about where the stock market's going over the next 3 weeks, 3 months. It's all entertaining to you, right? It's interesting, but like you're not placing bets on this, on that. You're thinking about these companies over the next several years. You're what I would call strong hands, and actually much stronger hands than actually most of Wall Street. So, and no different than Wall Street. Wall Street, there's a segment of Wall Street, and it's a huge segment, not very intelligent. Not very intelligent. They're some of the weakest hands. They follow each other around like little sheep, man. We're going this way. Oh, we're selling this stock now. Oh, we're buying this stock now. Oh, Nvidia's the hot play. Let's buy Nvidia. Oh, Palantir's a hot play. Let's buy Palantir. Oh, now they're not the hot ones. Let's sell those. Like, they're a bunch of sheep on Wall Street. They're clueless on how to actually value companies and how to play this game on a high level and understand business models and things like that. And there's a segment of Wall Street that's very intelligent, and they're very in the know. And they are very understanding when the market's going to go up, when it's going to go down, when certain stocks are going to go higher, where certain companies are going to get their earnings from over the coming years. So, in life, you got to understand not everybody's created equal. It's just the bottom line. Like you think like, oh, everybody's the same intelligent, everybody's this. No, it's just not the way it works. Some surgeons are way better than other surgeons. I hate to break the news to you. Some dentists are way better than other dentists. You might think they're all the same. They're not. Some doctors are way better than other doctors. You might think they're all the same. They're not. Some lawyers are unbelievably great. Some lawyers are horrible. You get what you pay for in life, right? Some cars are unbelievable. So amazing. Some cars really suck, right? That's life. That's life. And so when we're talking about retail investors, let's not coin them all up to weak hands. They don't know what they're doing. There's a big segment of that. But there's a big segment of highly intelligent, like some of the retail investors you'll find are some of the most intelligent people in regards to the market and understanding this stuff on a high level that you'll find in the world. Like way more intelligent than people you'll find even running big hedge funds that have billions of dollars of assets under management. Like you'll find some random guy in Iowa who's 10 times more in the know than some hedge fund manager that's got a fancy office, right by Central Park or something like that. Like that's just the way it is, man. So don't group everybody together. There's differences, big differences.
The 1920s. And then it enumerated how electricity came out, right, and General Electric and RCA and so on. And those companies went down 90%, not because of the economy and so on. The bubble burst first because they needed cash. So you have to understand that wealth can't be spent. In order to get money, you have to sell wealth in order to get cash to get the money to buy things. And so when that happens, bubbles burst. So bubble bursting means, let's say, a tightening of monetary policy is classic, but also something like wealth taxes can happen. For example, think about wealth taxes forcing sales of assets that you have to.
And you're right. By the way, there's a proposal for a wealth tax in California right now.
So state and national, right? State and national. I'm just trying to describe the mechanics of a bubble.
But you said we're at 80%.
Well, yes, I have a bubble indicator that goes back to 1900, and it just has a number of indicators. How much leveraging? Who has the leveraging? Is it what is the amount of money in wealth that relative to the amount of cash that needs to exist, and so on? These indicators, there are a number of them, show that we're on that chart. If I was to show you the chart, it's about 80% of where it was in those two times. That doesn't mean that that's the end of the move, okay? Because bubbles have to be pricked.
Right.
And so you can measure that there's vulnerability, a lot of vulnerability. There's a lot of vulnerability of who's holding what.
Here's my question to you about that, which is if the bubble is at this 80% range on your index or metric, there are folks, we had Paul Tudor Jones come in here a couple weeks ago, and he said, look, I think we're in October of 1999. By the way, the market would still have 40% to go. Back in 1928, Charles Merrill, who founded Merrill Lynch, told everybody, get out of the market because he thought it was a bubble. And he was right and he was wrong insofar as from the beginning of 1928 to September of 1929, stock market went up 90%. And so...
But I think that when...
I hate this discussion. I hate it. When we start bringing things back to such an unsophisticated market of 1929. Like, people didn't even know anything about the market back then. Like, you want to talk about gambling on the highest level. Like, people were taking out 10 to 1, 100 to 1 margin, just throwing it out there on stocks. And no one even, there was no conception of like what a P ratio is back then. Or like, the market is a billion times more sophisticated than it was back then. So like, I hate when we bring it back to the Great Depression. I'm like, dude, that was a whole different economy. That was a whole different like amount of wealth in the world at that time. Like, that was, you can't even compare it. You know, it's just ridiculous, man. It's just ridiculous. Like, why don't we compare it to, you know, something that happens, you know, 5,000 years ago? Like, it's ridiculous. So I hate when they bring this up and it's like, dude, like, no.
Looking at that, you're looking at it incorrectly. Okay. What is a bubble is the definition, right? I want to reiterate, a lot can go up before the bubble bursts. A bubble is an unsustained set of circumstances. It has unsustained amount of buying.
Right.
It has an unsustained amount of valuation. It has, and then there's something that pricks the bubble.
Is there a way to sustain this, though?
You can't look at, don't sell just because there's a bubble. Okay? Don't sell just because of bubble. But if you look at the correlations with the next 10 years returns, when you are in that territory, you get very low returns. By
the way, JP Morgan just did a report on this that showed that if you got in at over a 23 PE multiple, typically over a 10-year period, your return is a delta between 2% and minus 2% a year over 10 years.
Yes.
Which gets to your point.
I just put out today a post on this, and you'll see the charts and if you go on that. So I think that you have to say it's unsustainable. Then you have to go to the timing. What is it that pricks the bubble, right? Mm-hmm. Typically a tightening of monetary policy. We're not going to have that now.
Okay.
Right? Mm-hmm. But you could have something. In other words, the need for cash.
Right.
The need for cash is always that which bricks the bubble. Because when you have wealth, you can't spend wealth.
Right.
You have to sell wealth in order to get the money to buy the things you need or pay the bills you have. That's the dumb. Right. So I think that the picture is pretty clear in that we are in that territory of a bubble. We are in that bubble territory, but we don't have the pricking of the bubble yet.
So it's important everybody understands the decade we're in right now. Because basically what can happen in the stock market is you kind of get like I call it an on-off decade in regards to things being really crazy in the market versus not very crazy in the market. And when I say very crazy in the market, I'm talking like you get massive drops in the market randomly, okay? So for instance, 1980s, insanely volatile, right? Like the 1980s was crazy in the stock market. 1990s, not nearly as volatile. 1990s is mostly just upward moves, right? There's some downward moves here and there, but 1990 is just chilling, like make a lot of money, like have fun, right? Now, 2000, 2009, extreme volatility. You had the tech bubble popping, right? Obviously, there was a lot of wars during the 2000 to 2009 timeframe. Obviously you had 9/11 during that time period. You had the great financial crisis. So 2000, 2009 was crazy, right? Didn't mean there wasn't money to be made in the market. You could have made a lot of money if you knew where to invest properly, right? But that was crazy. Then we had 2010 to 2019, chilling. Like, we're sure we had some drama here and there. We had the 2018 drop at the end of the year, right? We had the double dip recession fears of like, that was around like 2010, 2011. Like we had some drama here and there. 2015 got a little crazy in the summer. Nothing, it was mostly just chilling, make a lot of money, right? 2020 through 2029, crazy. We're in a decade right now of just craziness. Like there's going to be massive moves down, massive moves up. There's going to be a lot of money to be made if you know what stocks to invest into. But it's a crazy decade we're in right now. And you got to understand that. That's where we're at, right? And so 2030 through 2039, I wouldn't be surprised if that's chilling. feet up, like just, not a lot of drama. So you better enjoy this decade we're in right now, because this is one of the crazier ones you'll get in regards to moves up, moves down, and you've already seen it. We had the 2020 insanity, right? That Rona crash was extreme. Like that was a straight V, like it was straight crash down, straight up from there, right? Then we had 2022 where the NASDAQ dropped 37%, insane. Then we have this year, which we had that unbelievable drop at the beginning of the year in March and April, right? And the NASDAQ went down around 20% there. And then now we got this drama, right? We're in a crazy decade. You got to understand that. And you got to just, like that's what it's going to be. We're going to have some time periods when things look really bleak and like just everybody's depressed on the market and like we're never going to make money. And there's other time periods that it's going to be just like, how did we make this much money this fast? And like I showed the public count, public count's been crazy over this past year. Like a year ago today, it was like $2.7 million, right? Fast forward to like February of 2025, it went up to like $3.1 or $3.2 million. Then it crashes down in the April situation, right? All the way down to $2.5 million. Then it goes from 2.5 million in April at those April lows all the way up to where it was last month at the peak, which was like around $4.2 million. And now it's crashed back down to 3.5, which is still up in like $1 million from where we were in April for the public count, right? And still up massively from where we started this year at, right? And then it's still up massively from where we were a year ago. Like 3.5 is a lot bigger number than 2.7, right? And that's with minimal deposits, because I only put like, I think it was like $500 a week in that account. So it's basically like nothing, for a portfolio that size. So we're just in a crazy decade, and you got to understand that. Take advantage of it, man, because I can tell you, the next decade might not be like this. It might just be chilling, making money. But this is where you actually get many of the best opportunities, okay? Speaking about the best opportunity out there, the Black Friday sale is coming. Pin comment down there. Let's see how many are ready for that. 966 people are signed up for the sale. I'm sure we'll be at 2,000 plus. Make sure every single person watching this, make sure you get advantage of that, take advantage of that deal. That's going to be unbelievable for the entire software suite, for the education portion. A lot of you guys need that as well. And once again, we're going to have a deal for 50% off a monthly membership and 50% off a 3-year membership. So regardless if you just want to join a short-term basis and pay month to month, or whether you want to get the ultimate deal and just join for a longer-term basis, it's going to be amazing. So that will be pinned comment down there. Make sure you take advantage. The things transpiring in the stock market are absolutely fascinating. It's flipping flapjacks all over the place in the stock market. Look at the past year for the public count. 1 year ago today, the public count was $2.7 million. Fast forward to February 2025, $3.3 million. April 2025, just a couple months later, down to $2.5 million. A month ago, public count's over 4 million, and now it's at 3.5 million. What an absolute roller coaster ride. You got to be ready for this one, folks. It's a lot of twists, a lot of turns, a lot of flips, and a lot of flapjacks all over the place. Google McDougal, this stock is incredibly strong. People are looking at like, man, how is this stock so strong? Now we're sitting on $60,000 of gains in the public count on Google stock, up another $3,500 here today. Meanwhile, Meta stock is just like insanely weak right now, still sitting on $760,000 of gains on this stock, even after this kind of crash in the stock we've had. But this stock is just incredibly weak, and people are like, well, how is a stock like Google so strong and a stock like Meta? Because you go back, a year ago, it was a complete opposite story. Meta was the one that was so strong, and no one wanted to own Google. Amazon's another stock. It's lost all of its after earnings gains now at this point in time. That stock is insanely weak. We're sitting on $127,000 of gains, but recently the stock has been very, very weak. Meanwhile, you have Nvidia come out with just absolutely blowout earnings. And the stock, what does it have to show with it? 5% up. I mean, this is where the stock was just 2 weeks ago, right? And their earnings were perfection. Like, we'll look at some of the numbers in this video, but their earnings report, their guidance, commentary, it was as good as it gets. Like, it doesn't get any better than this. And yet 5%, like, the market was expecting a 7% move in either way. It's not even keeping up with that, right? In this video here today, 2 core subjects I want to get into, okay? First one, the main one of this video is I'm going to explain what's actually going on in the stock market right now. Not a lot of people understand all the ramifications, what's going on here. They're looking even at things outside the stock market like Bitcoin and how all this works together. Very important I explain that in this video here today, okay? I'm going to take you back and show you everything and how this whole movie plays out essentially. Number 2, the stocks I will be buying over the next week or two, understanding with what's going on out there in the market. One thing and one thing only I need from you guys, if you could please just smash that thumbs up button on this video, that little like button. That would mean the world to me. Thank you so much for everybody that's already done that. You are the best, okay? Additionally, make sure you're subscribed here to the channel so you see more of my videos in the future if you enjoy my content, okay? Additionally, I want to say I appreciate you guys more and more every single day. You know, I've been kind of blowing up on X over the past year. I took that over. Somebody used to run X for me in the past, somebody from my team, but I took that over in the past year and I run that exclusively now. And man, X is so annoying. Like, there's just so many like people that don't understand anything and they just, you know, noobs and market gamblers. And I just appreciate you. Like, every time I'm like on X, I just appreciate all you guys so much more here on YouTube, because you guys are here to learn. You're here to hear my perspectives and opinions and everything like that, right? And you're not always going to agree with me, and that's fine. But like, you guys are just such a level up, so much more mature than like the X community, man. Sometimes I'm just like, I got to do it because it is an important platform, but it's just like, sometimes I just get annoyed with them, man. I appreciate y'all in the biggest way. Every time I get done with that, I'm like, oh, thank goodness I get to actually post for some actually intelligent people on YouTube, okay? Additionally, want to let you guys know, we are now only 8 days away from the big Black Friday sale for 1000xstocks.com. That is the entire software suite and the education portion of 1000x as well, okay? And when you join us in there, we'll send you your Steel membership card to your house, condo, apartment, wherever you live out there as well, okay? This is a private group card. This is a lifetime membership card. You won't get those cards because those are for my private group, but you will receive this Steel membership card. I got one right here, 1000x. This is a 2024 edition, so you guys will receive the 2025 Steel edition. We're gonna have a deal on a 1-month membership and a 3-year membership, so that's gonna be phenomenal. Pinned comment down there, enter in your name, enter in your email, and then I would enter in your phone number so we can text over the deal when it drops on Black Friday. You know, your inbox is going to be flooded with a bunch of BS on Black Friday. Get something that you actually can help you make more money, right? Like 1000x is going to help you make better investment decisions. You're going to be a much more informed investor if you get 1000x. You don't get 1000x, you don't get the deal. Like, good luck, okay? So get that deal. That will be pinned comment down there. It is coming up here fast. It'll be here before you know it, okay? Alrighty, ladies and gentlemen, are you ready to rock and roll? Let's get into this. Very important. If you look at the market since the 2022 low, right, which was in the fourth quarter, the Qs, which think of that as like NASDAQ 100, the big 100, you know, market cap stocks in the NASDAQ. It's up 124%, a shocking move. Like, if we went back to late 2022, no one saw this coming. No one. Even, you know, people like Tom Lee were starting to get really like kind of bearish and just like very calm with their tonality. Let's just put it that way. Anybody that was bullish was scared to even mention they're bullish at that particular time, because you've been in basically a year-long downtrend. And then the bears were in full-on onslaught. All the Wall Streeters were so negative on the market. I'm just telling you guys, no one saw this coming. The 124% gain since that low. In 3 years, no one. No one. Not one bull, not one bear. Incredible, right? Now, why has this happened? That's a very important thing. It's really been led by 4 core things. The first is big tech's revenue growth. Big tech was in a bad spot at the end of 2022 going into 2023 when it came to their revenue growth, and they completely reversed that, and big tech has gotten back to very strong revenue growth over the last 3 years. That's one of the big reasons this gain has happened. Additionally, if you look at the big tech stocks, the ones that matter the most to the market, they've had earnings per share increase quite dramatically, and margins. We're talking gross margins, net margins have been increasing quite dramatically for those companies as well. The only one I can think of that's a big dog company that hasn't had that is Tesla. But outside of them, like basically every single other stock out there has basically had major earnings per share and margin expansion as well over the last 3 years. Additionally, big share buybacks. Almost all these big tech companies, pretty much all the big tech companies, have been doing massive share buybacks, and that helps your earnings per share even more, right? And then we can say chip spending has definitely helped this whole wave as well with Nvidia stock. Nvidia has become the biggest market capitalization company in the entire world. It definitely used to not be like that, and that has definitely helped push the Qs up as well, right? So those 4 things are why the stock market has increased this much. The Federal Reserve lowering interest rates a little bit hasn't done a dang thing. It hasn't mattered at all, just to be quite frank. And even when the Fed was starting to raise it, it's still raising interest rate, the market was already going up. And that's because big tech revenue started to trend the other way, right? Earnings per share, margin started to increase. It did, a lot of firing of employees, all that sort of stuff. So the market was already bouncing heavy way before the Fed could even think about stopping to raise rates or even think about cutting rates. These are the four main reasons why the stock market has increased so dramatically, and specifically the top of the market over the past 3 years, okay? Now, what if I told you all the three of these four categories are under attack over the next 24 months? What three categories are they? Earnings per share and margin growth, big share buybacks, and chip spending. They're all potentially under attack the next 24 months. And let me explain it to you like this. This is extremely important everybody understands this, okay? What's occurring right now is unbelievable spending when it comes to all these companies on CapEx and, with all the Nvidia chips and then building out these massive data centers and everything like that. All these companies are spending a fortune. When I say all these companies, I'm talking about the big dog companies, the Metas, Googles, Amazon, Oracle, go down the whole list of them, OpenAI, et cetera, right? So this ends up catching up to you in a pretty substantial way, okay? And here's why. So let's say Meta spends $72 billion on CapEx in 2025, okay? Now let's say they're going to depreciate all this CapEx over the next 6 years, because a lot of these companies have now moved to 5 or 6 year cycles. Some are at 5.5 year cycles, are saying. So all of a sudden, Meta has to start taking a $12 billion depreciation hit per year. They have to take that in 26, 27, 28, 29, 2030, and 2031, okay? That's already a big number. That's going to kill a lot of your earnings per share growth because it's hard to increase your net income $12 billion a year. But here's the issue. Meta's already been spending, and they're going to keep spending even more aggressively, right? Zuckerberg's talking about much more aggressive spend next year. So maybe they bump that up to $90 billion of CapEx in 2026. They need to depreciate that over 6 years. That's another $15 billion depreciation hit per year. So now Meta is getting hit $27 billion of depreciation. Ooh, do you see where this starts to become a problem with your earnings per share, right? And everybody that, if you understand income statements well, you know what I'm talking about right now. If you don't understand income statements, I apologize, but, understand income statements, okay? Join my private group, take a college course on accounting, do something, okay? Get the sale for Black Friday for 1000X. We have a whole, basically module inside 1000X that explains income statements. Everybody that understands income statements, you know what I'm talking about right now, okay? Now, Meta, let's say they bump that up to $102 billion, a very small increase on a percentage basis. That's only a little over 10%, increase of CapEx into 2027, right? They still need to then depreciate that over 6 years. That's another $17 billion hit. Now we're talking about Meta's now taking $43 billion depreciation hit per year. $43 billion, ladies and gentlemen. It's hard to increase your net income $43 billion. So what ends up happening essentially is your depreciation starts to become so massive. It basically is wiping out all your net income increase, and it looks like you can't grow your earnings per share as a company. That's no bueno. That's no bueno. And then you could say, well, maybe investors start to judge these companies just on EBITDA, right? Which is earnings before interest, taxes, depreciation, and amortization. That's a possibility, and EBITDA is an important thing to look at. But you got to understand, people really like the net income in the EPS, because some people look at EBITDA as BS earnings, essentially. Why? Well, if you're just looking at your earnings, but you're not taking into account all the interest you might have to pay if you took out a bunch of debt, or the depreciation, and all those sorts of things, like your taxes, people are like, well, that's not giving you the full picture. That's just a very small window. How much are you actually bringing home at the end of the day? Where's the bacon at? And how much bacon you actually bringing? Because this is we still need to divide up the pack of bacon at this point in time when we're talking about EBITDA, right? And do you know who would always call it BS earnings? The late, great, rest in peace, Charlie Munger, Buffett's right-hand man. He said, I think every time you see the word EBITDA, you should substitute those words with BS earnings. Here's the deal, okay? EBITDA is important to look at, but the moral of the story is, on a mathematical basis, right, Companies, all these big tech companies that are spending a fortune, their earnings per share and their net income, it's going to be really hard to increase those in any substantial way over the next few years because these companies' spending is so out of control. It is getting so insane where some of these companies are now spending more in a quarterly basis than they're bringing in profits, ladies and gentlemen. That's how extreme it's getting. And these companies are talking about taking it up to another level in 2026. This is all going to catch up at the end of the day. This is all going to end up catching up because you can only get away with that for so long before the market says, nope, no more of this. This is out of control. Okay. So all this depreciation is going to start to kill net margins of these companies over the next few years. And it's going to kill earnings per share growth, right? That's a problem. And so we're about to run into a situation that we haven't had for years, which is going to be around earnings per share and margin growth. That's going to be tough. Like some of these companies, their earnings per share and their margins could start heading the wrong way in 2026 because of the massive amounts of depreciation. Okay. What about share buybacks? The big share buybacks. Here's the deal. If all these companies are spending, $50 billion, $100 billion on CapEx, guess what? They don't have all the extra money to go spend on share buybacks. So if they can't buy share buybacks, remember, almost all these big tech companies are always diluting shareholder value. You know why? Because they're usually issuing a ton of shares to their employee bases. In the tech field, it's very commonplace to essentially get paid out in a lot of your equity in shares, right? So these companies are going to have to cut back massively on their share buybacks. The only one that I think could get away with doing massive share buybacks over the next few years is Nvidia, because they're the ones that actually bring in home all the money, right? And they don't have to deal with the crazy amounts of depreciation that all these other companies do. So the share buyback situation might actually get much tougher because these companies are like, we need to spend, like Meta's worried about spending $72 billion this year. Next year, they might spend $90 billion on CapEx. Where's Meta going to get the money that's going to eat all their profitability? Like all their profitability is just going straight to CapEx. So they have nothing left to spend on share buybacks, which means if anything, the shares outstanding could potentially go up. So there you just lose another leg of what's carried us higher over the last 3 years, which is share buybacks, okay? And what about the last one? Chip spending. Well, most of these companies are not going to be able to increase their CapEx in any substantial way in 27, 28, or 29 because the depreciation is going to catch up to them in such a major way. And the massive CapEx numbers is going to catch up to them in such a substantial way, right? Which means chip spending, that's in terms of the growth. That doesn't mean these companies are going to stop spending. That doesn't mean if Meta goes to $90 billion of CapEx, that doesn't mean suddenly Meta's like, we're not spending on CapEx anymore, cut it to zero. No. They could just do 90 billion again the next year. But the problem with that is then you're getting no increase in the amount of spend with somebody like Nvidia, which means Nvidia's revenues then do what? They flatline. If Nvidia revenues start flatlining, no one wants to own Nvidia stock when it starts to flatline revenue, because usually what happens with Nvidia, once they flatline revenues start going negative. No one wants to own Nvidia when the revenues are going negative. There's just no way around that, right? So there we run into three issues all simultaneously. That's a problem. That's a problem, right? Now, if we look at the biggest market cap companies, in the world, right? We got Nvidia there, which Nvidia in 27 and 28 could end up having flattish revenues. These days of insane revenue growth are going bye-bye in 27 and 28, right? Microsoft's going to run into a massive depreciation problem. Google's going to run into a massive depreciation problem. Amazon's going to run into a massive depreciation problem. Broadcom's likely going to have a slowdown in 27, 28. I don't know if their revenues will necessarily go flat, but definitely have a big slowdown from what their growth rates will be in 26. Meta's going to have a major depreciation problem. TSMC is going to have a major slowdown in their business, right? And then Tesla's going to have a major depreciation problem as well, right? Now, with that being said, me personally, how do I look at this? Well, I'm going to look through the massive depreciation problem, okay? I will look through it. At the end of the day, I have no problem investing into companies that have major depreciation. I do this, like Cheesecake Factory. I love Cheesecake Factory stock. They have lots of depreciation. You know why? Because they have all these restaurants and they have all this equipment, and so lots of depreciation that company always has to take. Wynn Resorts, a resort company I love, right? Guess what? They take, usually $100 million to $200 million per quarter of depreciation hit because they build these massive resorts. So I'm no stranger to buying companies that have major depreciation, and it's fine with me because at the end of the day, like, depreciation is a non-cash expense. So it's not as bad as it looks. And especially with the stock, I put it up here, right? I said, especially with the stock like Amazon, for instance, right? Amazon has always had massive depreciation. This is nothing new for them. It's a bigger issue if you're a company that's usually asset light. That could be more of an issue, a la Meta, which is my biggest investment in the public count, a la Google, right? Although Google's over the years has gotten more asset heavy, a la Microsoft. Those sorts of companies, Oracle, they've usually been seen as more asset light business models, high margins. Unfortunately, that's all changing now. And so those companies are now becoming very asset heavy. And so they're going to have to deal with this massive depreciation that they haven't had to deal with. Amazon's been a low margin business forever. Amazon's been an asset heavy business since I got in the market in 08, 09. This is nothing new. Amazon's been building the biggest data centers in the world for the longest time, right? For all their AWS cloud business. They're the big dogs of the big dogs. They've been building all these massive warehouses all over the world, right? And their fleets of vehicles and their fleets of airplanes and all this stuff. Depreciation is nothing new for Amazon. So if there's one company I'm looking at that I'm like, I'm not worried at all about this, it's Amazon. This is nothing new for them. I do worry about the other companies because their margins are going to start going down substantially. And how does the market take that? Their profitability is going to start eroding, right? And people are going to be like, do I really want to own an asset heavy blah, blah, blah company? I like them because they were asset light. That's going to be a big problem. Amazon's nothing. They've been asset heavy for the longest time. They're going to be asset heavy until that company's, gone, which, might not be in our lifetimes, but someday that company will be gone and they'll always be an asset heavy company. So that's my personal view. I'll look right through it. I'll continue to buy Amazon shares. Like Amazon under 250, I'll continue to buy that. It goes under 200, I'll buy it heavy. I don't care about the fact that they're spending heavy. They'll get the return on investment. This is not Andy Jassy's first rodeo. He's been spending heavy. He's the one that really built out AWS over the last, decade, 2 decades at this point in time, right? And so I have no issue with that. Now that leads me to Nvidia stock, right? Nvidia stock. I made a prediction, I think it was about a year ago now at this point in time, that Nvidia stock will basically be stuck in the 125 to 200-ish range for years, right? And I still stand by that at the end of the day. And the reason being is no one can get that excited about Nvidia. They just reported the most insane earnings report you could. There's nothing bad you could say about that report. I ran the numbers. It's unbelievable. The income statement's an A+. It's 100% perfection, right? The guidance was insane. It was way ahead of what Wall Street said. And it can't even make a big move up. You would think the stock would be up 20, 25% after hours. Blowing numbers out of the water like that, having the guidance it has. But everybody's looking through that because they understand the problems that are going to be coming in 27 and 28 for this company. And so that's why that stock just remains stuck. And so when people get bearish around Nvidia, they'll sell it down to 125. When people get very bullish around Nvidia, which we're certainly this is pretty much as good as it gets in terms of the news cycle for Nvidia, right? They'll bid it up to that low 200s and then it's just stuck there. And so you can't get any major move up, right? And you also can't get a total collapse in the stock because the profits are still so amazing and will still be amazing even if they go flat revenues, right? They're still going to be making so much money, it's ridiculous. And the balance sheet's phenomenal. So it's a hard stock to really bet against in any major way, but also it's a stock that's very limited with upside now at this point in time. And so that just is what it is for Nvidia. And it is what it is. No, what's that lead to AMD? Because you might say, okay, if these companies aren't going to be increasing CapEx much at all in 27, 28, 29, let's say they're flat CapEx wise, well, what does that mean for AMD? Here's the deal. I let my private stock group members know this. I said, with AMD, right, they're going to be grabbing market share 2027, 2028, 2029. They're not counting on major CapEx increases at Meta, at Google, at Amazon, at Microsoft, at OpenAI, all these companies, Oracle. They're not counting on that. They don't need that because they're going to then be grabbing market share. Nvidia is still building actually market share on AMD right now in this space. The raw numbers out of Nvidia are substantially bigger than AMD. AMD finally starts to eat into the numbers really in 2027. And that's because in the back half of 26, the 450 goes into production. And that's a chip that everybody and their grandma wants in big tech, right? And the sales numbers will be incredible. And so AMD finally starts to eat into market share, 27, 28, 29. So they're not counting on that. They're not like the company that's benefited huge from this. Nvidia is the company that's already benefited huge from this. Okay, so AMD is a company that's about to benefit huge from this, and AMD is the value play. So as these companies start to realize, crap, man, we don't have it to keep increasing CapEx substantially in 27, 28, 29, they're going to realize we got to go for the next best thing that's at a very attractive price point, and that's AMD. And so AMD will really be able to eat into market share quite substantially. And I don't think a lot of people are even aware like how big this is going to be. And so right now, AMD's stock is moving with Nvidia. Like if Nvidia stock goes down in a day, like AMD goes down. If I was looking after hours, AMD stock's up because Nvidia stock is up, right? And like Wall Street doesn't get it yet. They don't actually understand there's a major difference between the business model that is Nvidia and the business model that's AMD and where these growth rates are going for these companies over the next few years. There's going to be a big divergence here. Some Wall Streeters are starting to get it because you can see already, like in the shorter term, like AMD stock is starting to outperform Nvidia quite substantially, but like they don't fully get it yet. Like it's not widely known that like, oh, AMD is going to be a market share stealer in 27, 28, 29, but they will get it as AMD numbers start to hit more and more. And what you're going to see in 26, you're going to have a very exciting quarter that happens in 2026. You're going to have, for the first time in years, you're going to have a quarter. I can't predict whether it's going to be the second quarter, the third quarter, the fourth quarter, but you're going to have a quarter in 2026 where AMD's revenue growth rate is going to be above Nvidia's revenue growth rate. And it's what I'm going to call the great flip. The great flip in the stock price has already started in regards to AMD flipping on Nvidia. In terms of revenue growth, that's the next tier. And that's when these Wall Streeters really start to get it, when they see, oh my gosh, AMD's revenue growth rate is actually ahead of Nvidia. My guess is we'll probably get that quarter between the second quarter and the fourth quarter. I don't think we'll get it in the first quarter. Probably be somewhere between the second quarter and the fourth quarter. We'll get that first quarter where AMD's revenue growth is ahead of Nvidia's. And everybody's going to flip their flapjacks and be like, oh my gosh. And so if you think AMD is exciting stock now, just wait till they flip Nvidia on revenue growth rate, and people are gonna be like, oh my gosh, I cannot believe this happened, right? Now, in regards to the spend, right, the CapEx, you always have to consider, like, what if something else happens, right? What if OpenAI and all these other big tech companies, what if their revenue absolutely goes insane? Like they start growing way more rapidly than what they're growing right now, right? And I'm talking as a percentage basis. Then you could say maybe they could actually up CapEx in a substantial way in 27. That's a potential, right? If Tesla, Amazon, Google, Microsoft, Meta, Oracle, OpenAI, all these other companies, if they really just grow way more rapidly than anybody's anticipating when it comes to top line, then you could say maybe they could keep up, like up in these CapEx numbers to shocking numbers. Like could Meta go from $72 billion in spend this year to like $120 billion to spend? They could, but like they're going to have to increase revenue at a much more rapid clip than what they're increasing right now. Like it would have to be like way more dramatic. So, but it is and this is a thing you got to take into account in the stock market, right? I never bet on absolutes, right? I think things are going to play out a certain way, but that doesn't mean that's the only range of outcome. That's one of the things you learn as you get more experience in the market. You think you're probably going to be right, and you might be right. If you put in enough work, right, and you study this stuff long enough, and you got enough experience, you're probably going to be right, but you might not be right. And so that's where you take a range of outcomes into account, right? And so when I look at a range of outcomes here, my guess is the highest probability is the big tech companies are going to be growing their revenue in that 10 to 20% range. 2026 through 2028, right? Which means they cannot afford to up CapEx in any substantial way in 27, 28, 29. But there's also a potential, like maybe these companies all grow revenue much more rapidly in, 26, and maybe they jump up to 25 to 35% growth. Like Meta's latest quarter, 26% revenue growth. Like maybe Meta goes to 33% revenue growth, 35% revenue growth, 37%, something shocking like that. If that happens, all bets are off. Like maybe they could actually increase CapEx substantially in 27, right? That's a potential. And then it's like, what if all these companies start growing at revenue 35% plus? Like, that's a super low probability. That's like the 1% probability or less, but it's a possibility, right? And then Nvidia, who knows, maybe they will become a $10 trillion market cap or something like that. But there's also another range of outcomes you got to consider. And that's what if these companies' revenue actually starts to, the growth acceleration actually goes the other way in 2026. And maybe these companies start growing like revenue less than 10%. That would be tough. Like, imagine if Amazon, Google, Meta grew less than 10%. I think it's a pretty low probability, but it's a possibility. And you have to consider that, right? And then what if these companies' revenue started going down? Once again, not super realistic in my opinion. I'd call it less than a 1% probability, but it's a possibility. So always understand you got to look for a range of outcomes in these situations. Never just bank on one thing happening, okay? And so that covers that portion of the video and what's going on there in the market and all that good stuff, okay? Alrighty, next up here, the stocks I will be buying over the next week or two and all those sorts of things. By the way, I hope you guys really enjoyed that first portion. Like, that was just straight educational and kind of looking at the stuff and mathematics and all that good stuff. Like, I hope you guys really enjoyed that. And I hope a lot of you guys love that sort of stuff, right? Because, that's that sort of in-depth stuff. I think you guys a lot of you, my big fans, you guys look for me for this sort of stuff, like to break this down and like explain the math behind it and all that sort of stuff. So I hope you enjoyed that, okay? Alrighty, so let's talk about some stocks I'm looking at buying over the next week or two. Okay, so I'm looking at ELF. ELF's definitely a stock I'm looking at this point in time. We've made an insane gain in the public count on this, 878%. But I'm definitely going to be looking across my portfolios at ELF. ELF's very attractively priced right now. Is it as attractive as it was back in the tariff drama? No. But at the end of the day, it's $70. Like, it's a good value here. I think ELF long term is going to 200 plus, if not 300 plus. Meta's a great deal right now. I mean, I kind of want to buy some more Meta. I'm looking through the whole depreciation situation they got going on for the next few years, but my problem is I have a lot of Meta. Right? Even after this massive crash in Meta stock, like still almost $1 million position in the public account. SoFi is a stock I'm still looking at. Like, SoFi has been an incredible performer, now up 221%, up 92,000 in the public count. But that's a stock I still like here. The more I look at SoFi, the more I'm just so convinced they're going to become a financial giant. And financial giant, we're talking about hundreds of billions of dollars in market cap long term. And that's why I think SoFi has the potential to go over the next 7 to 10 years. And so, there's going to go through a lot of ups and downs over time. But as long as Anthony Noto makes it through the storms of that company, they'll be fine. Google's now at fair value. Google doesn't interest me as much. Google was really interesting, but now as approaches that $300 price point, it's at fair value, I would put it. There's a lot of excitement around Google. Obviously, the stock has turned huge. A lot of excitement around Gemini. And some people are saying, I was reading on X, some people are saying like Gemini's now passed up OpenAI in terms of ChatGPT, which doesn't surprise me if it does. And I think that's debatable, but if it does, it doesn't surprise me at all. Like, Google's been working on AI for a long time, and they've always been the company in the world that I would say always has understood AI, algorithms, all those sorts of things in a much more intelligent way than anybody else. But we'll see what shakes out with that, right? And by the way, that space is going to be incredibly valuable. You got to understand, like, whoever wins, you guys ever see the movie Iron Man and Jarvis, right? You understand whoever wins that as the personal assistant of humans is going to be absolutely massive, right? And so imagine some people are already starting to use these platforms like this, but imagine the future where, Gemini or, a ChatGPT or whatever, it knows everything about you. It knows how tall you are, your weight, your health, how you eat, the type of music you listen to, your lifestyle, how much you work out, all these sorts of things, right? It's all tied in. It knows everything about you, kind of like Jarvis in the Iron Man movie, right? Imagine how valuable that will be. They'll be the most valuable product we've ever seen in human existence, and it's not even really close. Because that thing will be able to tell you exactly what you should do at all times, right? Like, hey, your heart rate's a little out of whack, you should go see doctor, blah, 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 right? Hey, you've been asking me about, how your chin looks, like maybe you should go see this plastic surgeon, right? And it's going to be able to like drive business to so many different businesses, right? And it's like, hey, I think you're feeling like Mexican food tonight, you should go to this restaurant. Like, the potential there is bigger than anything we've seen in history, right? Because Google search has really been one of the biggest things to ever happen in human history in terms of a great profitable business model. And the reason being is it knows so much about you. You're typing in so much to Google search over time, right? That's an incredible business model they built there. But this next wave, this Gemini, ChatGPT, like that's going to be a whole different level, you know, in terms of how much it knows about you and the sort of business it'll be able to drive. And that will be likely the most profitable business we've ever seen in human existence. So just understand that game, and that's just one component of AI, but that game is really big, and that's why Google wants to fight hard in that space. That's why ChatGPT will fight hard in that space, and others will as well, because man, I'm telling you, whoever wins that battle, whoo, baby, is that gonna be big. That is gonna be huge, okay? Celsius, another stock I'm looking at here. Celsius, I mean, just is a very, very good value right now. Very good value on that one for a company that's on their way to becoming a drink giant. And they got the Pepsi distribution now at this point in time. Like, they got a runway of US growth that's incredible, and then international growth. Like, that's going to be insane. Now that they got the Pepsi distribution for all their businesses, like, oh my gosh, like, can you imagine? Like, energy drinks is such a underappreciated business, in my opinion. Like, one of the best stocks, you know, really over the past 25 years has been Monster Beverage, right? And just an incredible performer. I used to own that way back in the day when it was Hanson's Natural Beverage, and just an overlooked company. And, you know, you don't always just need to own tech companies. Like, some of the best performers you ever get. Like, look at Elf. Elf gave me 878% return. Like, not a tech company. SoFi, you can make an argument that they're more banking than tech if you want, but look at 221% gain. You don't always need to be in tech companies, okay? So Celsius is a great company. Amazon, you know, people look at that as tech, but you could also look at that as just infrastructure and commerce in general, right? Amazon's a great buy now. Fubo's a great buy, in my opinion. It's more speculative, obviously, with Fubo, but man, I'm really excited to see their financials over the next couple quarters, especially that top line and subscriber growth. Estee Lauder, EL stock, whew, I mean, what a great deal that stock is. Phenomenal turnaround going on there. One of the most underappreciated turnarounds, I think, in the stock market right now. Cheesecake Factory up $10,000 on that so far. What a steal deal cake is. I got a lot of stocks that I'm just looking at. I'm like, oh my gosh, these are trading at these sorts of valuations. PayPal, oh my gosh, like, I love that stock. Like, oh my gosh. American Express, another banger there. Salesforce CRM, another banger there. Like, Salesforce, I don't think people are understanding like the revenue growth rates at companies. They're about to go through a revenue growth acceleration phase in 26, 27. I don't think anybody's even factored that in. So that's going to be really exciting. Adobe, I love the acquisition. They just made that's one of the most hated stocks in the market. It's facing tax loss harvesting. Some of these stocks are facing tax loss harvesting right now, like a PayPal, like a CRM, like an Adobe, because at the end of the day, like, people just, you know, they've likely lost money on this for hedge funds. So they sell. It doesn't matter what the valuation is. They're just selling, right? Because they need to write it off against Nvidia gains. Nike, another great stock that's priced very attractively, Honest as well, right? And I don't know if you guys watched my reaction channel, Jeremy Lefebvre Makes Money, but I spoke about, in this video I released yesterday on the channel, looks like 84,000 people have gotten to see it so far, 3 new stocks I'll start buying. That goes into 3 brand new stocks, and I'm going to start likely positions in 2026. So if you want to hear me talk about some brand new stocks, definitely enjoy that video. Very exciting day. I just signed up a bunch of awards. My wife had me sign up. Last week, we had 4 people join the 7-figure club and 15 people join the 6-figure club. My guess is those people actually probably reached it on in October, and then were just straggling and finally got to submit for the awards last week, essentially. But obviously very exciting. And, you know, remember, you're playing this game for the, you know, where your net worth is going to go over the next 5, 10, 20 years, right? You're trying to position yourself now for looking back in 5 years, 10 years, 20 years from now and be like, dang, that was a good decision, right? As, you know, I've been in this game now 17 years, and I'm able to look back and be like, thank goodness you got into this, Jeremy. Thank goodness you started investing. Thank goodness you bought this stock. Thank goodness you bought this stock. Thank goodness you, like, you know, had more income than expenses and stayed focused all these years and things like that, you know, because of that, I'm able to live the sort of lifestyle I'm able to live, and those sorts of things. And man, just be in a very different financial situation than if I hadn't gone down this route of investing for the past 17 years. I can tell you that much. So remember while you're playing this game, okay? Pinned comment down there. If you have not entered in for the sale yet, make sure you do that. 1000X sale. If you're not in my private group, like, you've got to get 1000X at least. That is an absolute non-negotiable must. And we'll be pinned comment down there, and look forward to that. Get the entire software suite. The education portion of that 1000X is phenomenal as well. It has 12 different education modules. It goes very in depth on very core subjects you need. And that sale is only a few days away now at this point in time. So pin comment to get down there and get ready for that. And then we'll send you your Steel membership card to your house. One of my biggest investments received a major downgrade here today. It is Amazon stock. This is one of my biggest positions in the public account. Patreon portfolio, I own a bunch of shares in my private portfolios, and they got downgraded here today. Stock moved down significantly. I want to look at the downgrade. I want to tell you my opinion on this downgrade here today. Then we're going to also listen to the analysts. The analysts went on Bloomberg 5 hours ago. We'll listen to their reasoning around this move, essentially, and my opinion on that. From there, we're going to go ahead and I'm going to show you my entire potential buys watch list and talk about what stocks I'm looking to buy next that maybe I don't have ownership in right now. Okay. After we get done going through that, I want to hear Tom Lee's perspective. Tom Lee went on CNBC in the past 24 hours, spoke about his perspective on the stock market, where things are headed from here, all that good stuff. So definitely looking forward to reacting to that in this one here today. I appreciate y'all for joining me. We just got so much to go through. All I need from you real quick, just please hit that little thumbs up icon. If you could just do that for me, that would mean the world. Everybody that's already done that and you didn't even need me to ask, I thank you guys so much for that. Little thumbs up. That's all I ask. Okay. If you guys want to be subscribed to the channel, you want to see more of my videos in the future, make sure to subscribe. That is, what are we at now? I think 121,000 subscribers, 122,000. So appreciate y'all for being here. Additionally, very proud to announce on this channel, we have a massive sale coming up for 1000xstocks.com that will be on Black Friday. So 9 days from now. Pinned comment down there. Click on that, put in your name, put in your email, put in your phone number so you can receive the deal via text. If you just want to do your email, do it, but you're probably going to end up missing the sale. You know why? Because on Black Friday, every freaking retailer is going to send you a bunch of crap emails about, oh, we're having a sale, 20% off at Hobby Lobby today. Come get your big sale. Like, come on, man. Okay. Oh, half off a pumpkin pie today. Like, you need 1000x. Okay. So do what you want, but make sure you get access to that deal. That will be pinned comment down there here today. And everybody, if you're not in my private stock group, make sure you get access to 1000x. That's the real deal Holyfield. You have to have access to that if you don't have access to my private stock group. Okay. Alrighty, guys. So first off here, Microsoft, Amazon received downgrade. Now, before we get into the why they downgrade the stock, you might say, how doesn't just an analyst come out and stock moves down 4% just because an analyst comes out and says, like, you know, we don't like the stock, don't buy the stock? Listen, these analysts work for usually big investment firms, or they work for a lot of Wall Street banks. And so what they say does carry weight. Now, many of these analysts are really bad at picking stocks. Their performance is horrible, okay? Like, very few analysts are actually good. And that's because most of these analysts, they never are actually investors for themselves. They're essentially go to some university, they get their degree, and then they get their first job as some intern at one of these Wall Street banks or investment funds or whatever, right? And then they get bumped up to like some like junior analyst position. They learn from the previous guy, and they finally become like a main analyst. And usually these people, it's not like these individuals built portfolios of millions of dollars of stocks and all that stuff and like had extremely successful track records. No. They just look at a business and they're like, well, this thing, the math says blah, 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 right? And then they go ahead and upgrade or downgrade stocks. And a lot of times these analysts follow each other around. So, you know, you can't really get frustrated at it. It's just part of the game. Like, you got to understand, if an analyst comes out and downgrades your stock tomorrow, like, your stock's probably going down big. Like, it's just a bottom line in regards to that, right? Especially when the market's shaky. If they come out and downgrade when the market, well, keep in mind, when the market's just rolling hot, a lot of times they won't come out and downgrade, and because they don't want to be on the wrong side of the fence, essentially. Okay, so Rothschild & Co.'s Redburn downgrade both Amazon and Microsoft to neutral from a buy. So basically, he's not necessarily bearish on the stock. He's just kind of thinking like this stock is going to perform kind of what the market does. So if the market goes up 5%, these stocks are going to go up 5%. If they're going to go down 5%, they're going to go, you know, the market is going to go down 5%. So he downgrades to neutral from a buy, as a financial firm does not believe the current titanic investments in artificial intelligence related infrastructure will produce returns justifying the expense. At first glance, Gen AI gross and operating margins are not alarming. Gross margins even resemble those seen in the early days of Cloud 1.0, said Redburn analyst Alex, and in an in-depth report published Tuesday. However, the comparison is misleading. Gen AI margins already assume longer depreciation schedules of 5 to 6 years versus just 3 years in the early cloud era. On a like-for-like basis, this means capital intensity for Gen AI is significantly higher, while pricing power is noticeably weaker. So basically he's saying like this business is not going to be as good as a cloud business 1.0 is, right? And I mean, fair point. That's very, very possible, right? Redburn analyst finds the net present value for the current generative AI build-out equates to 20 cents for every $1 spent. In comparison, mature cloud 1.0 investments generate about $1.40 for every $1 spent. Now, let me push back right off the bat here in regards to this analyst note, and then we'll finish going through the rest of this, okay? Listen. When you have a new generation of something, it's hard to say what the margins are going to be of that product 3 years out, 5 years out, 7 years out, 10 years out. You can make assumptions, but it's very, very difficult to do that. And so to assume the margins are going to be here, or you're only going to produce 20 cents for every dollar spent versus $1.40 and $1, like those are like very hard. Like no one that's spending all this money on all this stuff right now is playing it from the short-term perspective of like looking at it from how much does this generate over the next year or next 2 years. They're all trying to position for the long-term success, right? And it's not like everybody was super like bullish on the financials of the cloud business over time either, right? And if we go back to cloud 1.0, you had companies like Dropbox, right? DBX. Dropbox was one of the early pioneers in the cloud space. Like they should have been positioned to, have that company be ultra successful. I don't think Dropbox's valuations really moved in the past 10, 15, 20 years, right? Somebody like an Amazon, for instance, like people were not seriously looking at Amazon from a cloud perspective 10, 15 years ago, and they really missed out on a massive opportunity there, right? And a lot of people had a lot of question marks about all that spend Amazon was doing. Amazon's like, oh, we're spending all this, and people are like, I don't know about this. Why are you guys spending all this money? Like, I don't even know if there's a business model for this, right? So you got to understand, like, you're going to have a lot of these questions on a new technological platform or doing something like this. And that's where you have to kind of say, okay, in this new business, like we have to have a little bit of faith, right? We have a little bit of faith that the executives know what they're doing here. And in the end, Amazon's got a pretty dang good track record of spend. Do they not? Like if you think about a company that, man, do they have an impressive track record? It is definitely Amazon. Another key difference is where the value occurs, says the analyst. During Cloud 1.0, hyperscalers captured much of the software layer economics themselves. In the Gen AI era, the value increasingly flows to the model providers like Anthropic or OpenAI, creating value leakage for hyperscalers, at least for the foreseeable future, right? That's debatable, right? You could have said the same thing, I think, in a lot of the 1.0 hyperscale situation as well. So do keep that in mind. Cloud 1.0 refers to the initial rise of cloud computing, which ranged from about 2010 to 2020. It included basic on-demand services like compute, storage, and databases. The key difference between early Cloud 1.0 and Gen AI lies in their underlying economics, the analyst wrote. Cloud 1.0 was built on commoditized hardware serving millions of customers, which allowed hyperscalers to achieve pricing power at relatively low cost. By Gen AI, by contrast, relies on expensive hardware and is largely consumed by startups, an audience over which the industry has little pricing leverage. Whether this lack of pricing power is deliberate to attract future winners or simply necessary because higher prices would deepen startup losses is secondary. The outcome is the same. Although Redburn said it is not yet bearish on the rise of AI infrastructure, it is also not bullish, hence the downgrades to neutral from buy. It also has a $250 price target on Amazon and $500 price target on Microsoft. Okay, so before we get into listening to the analysts, let me share my last thoughts in regards to the subject before we listen to him, okay? At the end of the day, these companies are spending aggressively because this next generation of AI companies may be far profitable and far more important than anything we've seen in the past, right? They might scale out their businesses in a much more rapid fashion than anything we've seen. OpenAI, no one heard of OpenAI unless you were super into tech. No one heard of OpenAI 3 years ago, right? Now that company we're talking about has a $500 billion valuation on it and could be going up. Anthropic, no one even heard of Anthropic unless you're insanely into tech 24 months ago. No one had any clue what that company was. And now it just raised money, and I think it's at a $350 billion market cap now. For reference, AMD, the B set is AMD, is at around a $400 billion market cap. So we're talking about these companies in a matter of just a few years are scaling out to, numbers that we've never seen before in history, right? Look at Palantir and how that business has been growing so rapidly, and look where their revenues are trending, right? It's almost shocking. So just understand this AI space. I understand there's a lot of bubble talk, and there's going to be companies that, just are duds in this space. But there's going to be some companies that build out to be far more profitable and far bigger than anything we've probably seen in history, right? Like some of these companies, they might end up becoming the biggest companies in the world 10 years out. Like OpenAI, like maybe they become the biggest company in the world 10 years from now. Like who knows? Maybe that happens. I don't know. Like look at how rapidly they're scaling. They're talking about, going from 13 billion in revenue to 20 plus billion, right? And before they know it, they'll probably be at 50 billion in revenue, 100 billion. I mean, it's pretty rapid in terms of the growth. So, just some food for thought in regards to that. And so these companies like Amazon, Microsoft, all these guys that are spending fortunes right now, they might end up making way more money from these companies long term than actually what they made in Cloud 1.0, and that's something to be considered there, okay? All right, next up here, Redburn analyst on his call to cut Microsoft and Amazon. And remember, the people leading these companies, I think sometimes people forget, like they just assume like, Andy Jassy just woke up yesterday and has no clue how to run a business, right? They assume like Satya Nadella, like, oh, he doesn't know what he's doing. Like, and I'm like, who are you to say like Satya Nadella doesn't know what he's doing? Like, have you seen what this guy's done since he took over for Steve Ballmer? What was that, 10 years ago or so? Have you seen the increase in business? Have you seen the stock price? Have you seen what Andy Jassy's done at Amazon? Did you know he has been the one leading that AWS unit all these years into one of the most successful businesses in the world? So like people act like these guys don't know what they're doing. They're just spending to spend. And I'm like, dude, these are legendary business figures. Like these are some of the top individuals in the world. If all this massive spend from these hyperscalers was done by, some no names you never heard of, and you're like, I don't know who these guys are, right? Okay, maybe you can make a debate around that, right? And they're just getting sloshed with money and they're just spending it out there. But these are some of the most impressive businessmen in the world that are leading the spend when it comes to the hyperscale side, and they've got incredible track records. Even if obviously they don't bring up Meta here, but if you think about Zuckerberg, like that dude's got a pretty good track record, does he not?
Thanks for having me on the show again. As you know, there's like this narrative out there that generative AI is like the early stage of Cloud 1.0, and our work really shows that this is increasingly misplaced. Purely from a capital deployment perspective, we estimate that generative AI deployments require 6 times more capital to deliver the same Cloud 1.0 economics. And that's something that really surprised us in our analysis, and that's why we downgraded heavy-hearted our hyperscalers. So I think it is really the economics are far worse than what we and that the market also believes.
So how does this end then, Alex? Because for these companies, it's been full steam ahead. What becomes the catalyst for them to realize exactly what you're saying, that they aren't producing the results to continue to justify the spend that they're undergoing?
Yeah, I think, post the optimization cycle, generative AI was quite welcome because it gave initially like the growth boost. So
here's another way to look at this. Okay, ladies and gentlemen, you want to talk about exploding growth rates of these companies 2 years out, 4 years out, 6 years out from now? Listen to this. Let's say Amazon, Microsoft, all these companies are, this is going to be very important what I'm about to explain here. Let's say they are undercharging right now. Okay, they're all undercharging for for their services right now. And the reason they're undercharging because they want to make sure these companies build out to be successful businesses. Okay, so they're all undercharging right now. Well, then as these AI companies get more proven, they make more money, right? They have more success and they're able to raise more money. Then Amazon, Microsoft, all these companies can go up on price over time, which would then cause their revenues to explode higher if they're way undercharging right now, right? That is something you have to consider. And if you're thinking about where these companies' revenue growth, 2 years out, 4 years out, 6 years out, if you have a company that's, let's say, a very small company right now, but and you're undercharging them, and let's say they're very successful in AI over the next 3, 4, 5 years, right? And they're able to raise massive amounts of money and start making huge revenues. Guess what? Oh my gosh, like the amount of money you're going to be able to charge that company is going to be exponentially more than you're able to charge them right now, which means massive revenue growth.
Top line perspective and also operating margin perspective, it doesn't look bad. But where you really have to focus on is on the cash flow generation and the cash flow conversion. And I think what will make them, slow down spending is just that the equity is just derate, because it will become more obvious that the economics just don't stack up to what they've communicated.
Maybe now is the start of that, Alex. You are starting to see some of the shares fall, but this downgrade you've issued, it's rare for these companies. There's so much enthusiasm. We were just looking at the Bloomberg screen of analyst recommendations. More than 90% of analysts covering these two stocks have a buy equivalent recommendation on them. How difficult is it to break from the trend in this sector that has a lot of hype, Alex? There's been a lot of careerists talked about of being willing to step away from the pack in stocks that had been red hot until recently. Was that a difficult decision to make just because of the pressure in the success, again, maybe until the last week of these share prices?
I think it has been a difficult one because we have been above consensus for a long time. We have defended these companies for a long time. But I think what is fundamentally different is, just to be clear, the cloud was perfect because the hyperscalers have captured the software layering economics on top of the infrastructure. If you believe that generative AI is big, the likes of Anthropic and OpenAI act as a platform, so they will capture more of the economics. But yeah, we need to be independent, and if the figures and the numbers tell you a different picture, you're just gonna act accordingly.
So what is kind of the balance to strike for these companies that are investing in something that for them and for many people, and most people, that AI holds lots of promise? Is it a case, Alex, of just over-investing, or is it just completely misplaced faith?
So this is, obviously there's so much bubble talk on, are we in an AI bubble or are we not in an AI bubble right now? I'm going to tell you right now if we're in an AI bubble or not. Listen, we are not in an AI bubble right now. You know how I know? Because in a bubble, you do not have analysts coming out and downgrading the most successful companies, the most legendary business leaders of all time. In a bubble, you do not have everybody and their grandma making videos on are we in an AI bubble? Like, I'm seeing YouTubers make videos about are we in an AI bubble that aren't even like stock market investors. Like, they have no clue about how to value companies or like technology like this, and they're making YouTube videos about this, and like it's all over the place, all over social media, and everybody's talking about, are we in an AI bubble, right? Like, that's the proof you're not in a bubble right now, right? If we were in an actual bubble, like, everybody would just be on this thing. You wouldn't have analysts downgrading it. It would just be like up and away. And the fact that you have so many questions actually means you're in a healthy marketplace right now.
I think most of the growth in terms of like compute and spending is just still driven by consumer inferencing and also like training, and actually on the enterprise adoption, where API is the best indication, it's mainly software development. So if you were to break it down, it's a software development, so coding cycle, and they have to invest, they have to be part of it. And I think the risk that they overbuild is significant, because we are basically scaling at a very inefficient stack because they haven't quite worked out, the efficiencies. And that's very different to the cloud, because the cloud really started to scale when it was really efficient. So I think there is an increasing risk there of overcapacity, and a lot of these projects may end up not generating any value at all. It could be negative.
Alex, one of the things that the common refrain of guests that come on here will say, okay, maybe there is going to be this moment of overcapacity, but it won't emerge until 5 years from now, maybe even more years, and it's going to take some time to really realize what the current time.
The thing you got to understand about all this, okay? Listen, I'm going to put you on some game in regards to the VC space, okay? The VC space starts getting really excited when they start to see companies get, big valuations put on them, right? If you were an earlier investor in OpenAI, you've made a fortune now, right? OpenAI, wouldn't be surprised if that goes up to $1 trillion valuation in the next year or two. Anthropic, they were talking about, $350 billion? Like, who knows, might be not that far in the future, and they may be raising out a $500 billion valuation, right? And you've got a lot of other players in the space. With these valuations getting pushed up in that VC space, that makes more people say, I want to get in this. Like, I want to get in the next OpenAI, the next Anthropic, and they start chasing, right? And that leads a lot more capital to come into the space. And guess what? That leads to a lot more money to be made by companies like Amazon, companies like Microsoft, companies like Google that have these big clouds that are spending aggressively. So you got to understand, like, we're still very early days in regards to that whole cycle, because these VCs, you know, in the VC investors, right? Because remember, it's not just VCs, it's like the VC investors, the ones that are putting money into these VC funds. When they see like Joe over there just 10x'd his money in 2 years because he got into this successful AI, guess what? The next guy's like, dude, I want to 10x my money in 24 months. That sounds amazing. Like, let's go chase after the next one. Like, we could afford to miss some. Even, you know, we take, you know, if we invest equally in 5 companies and 4 of those fail, right? Or don't move much as far as valuation, or in one of them becomes a 10x opportunity, like, we did phenomenal for ourselves. We'll take that every single time, right? It's just math. It's just math. If you're a VC investor, right, high net worth individual, and you put $10 million into a fund and they put $2 million in 5 different companies, and one of those companies goes on to 10x, and the 4 end up either becoming duds or just are flat and you don't really make much at all, or you maybe even lose money, you still made a ridiculous return on investment. Right? That's the VC space. Like, you just got to find one that's the next big, huge thing, and you make more money than you ever dreamt. And so just understand, with Anthropic's valuation, with OpenAI, when you hear about some of these other companies getting these bigger and bigger valuations in the AI space, that's going to make a ton more money flood into the next. What's the next Claude? What's the next Anthropic? What's the next, Andril or whatever it's called, right? What's the next OpenAI? Like, they're going to chase, and that money ends up flowing into the big cloud companies like Amazon, Microsoft, Google, McDougal.
Dynamic is, why go in with a downgrade now? Why not say it's going to take some time to figure things out, but for the meantime, these companies are going to be the beneficiary of an AI build out?
They're simply not the beneficiary. I think the market is telling you already. We've seen a third quarter where across the board, top line expectations have been beat, buy side expectations moved up, and yet the stocks, started to derate because investors have upscaled, and people start to look at the economics much more than the top line. So if we make this call later, it's too late.
It's a fair point, Alex. We're finally looking at more into the balance sheet than what used to be the case for these tech companies of just being like, hey, that's a nice cash pile you have there. May I have some of it? Considering how much things have changed, that these once asset-light companies are now asset-heavy, that depreciation costs start to stack up. Just how different is it to be a tech analyst?
Wait just a minute. Hold your horses for one flip and flapjacking moment. Listen. Amazon has never been asset-light. At least since I've been in the stock market, since I got in 2008, 2009, 17 years ago, right? That company's always been asset heavy. And they're more asset heavy every single year, basically. They have massive warehouses. They got an unbelievable workforce of 1.5 million or 2 million people or whatever work for that company, right? They have all those vans driving all over the place. They have a fleet of planes. They have AWS, massive data centers all over the world. Like, Amazon has never been asset light. So when we're talking about Microsoft, if you want to look at them differently, because you're like, ooh, they're going from asset light to asset heavy, that might be fair, right? Same thing with like a Meta. If you're thinking Meta is going from asset light to asset heavy, you can make arguments for some of those companies. But Amazon's always been asset heavy. So the fact that they're spending fortunes to, position for the next AI cycle and they're going more asset heavy, that's what we're used to with Amazon. That's, we're already used to a low margin structure with Amazon. Amazon's never been a super high margin business. It's not like this is the type of company that has 30% net margins. Like, their net margins are like this much, but they do so much business. They're going to be the first company likely to $1 trillion plus of revenue in the next few years that, guess what? Like, it's fine.
Right now at Redburn, how differently are you looking at these companies as a completely different prospect than they were just a mere 5 years ago?
They are capital-intensive business models, so you have to take a very different approach. And my focus is basically just on the hyperscalers. And I think there's one other point that is quite important because these companies always try to tell you that this is very similar to the cloud 1.0 early days in terms of economics, but it's simply not, because in the early days of the cloud, these companies have assumed, a 3-year server lifetime, and now we're starting off with generative AI with a 5 to 6 year server lifetime. So it's very, very different. I think the debate is becoming much more nuanced, and we advise investors to be much more critical.
Hey, Alex, just quickly, because obviously what Nvidia does also drives a lot of the companies that you oversee. Is there anything on Wednesday that would make you feel more positive about the companies you cover, about Amazon, about Microsoft, about Oracle?
Not at all. No, I think for us it was not a short-term call. This is like a structural issue for the industry. It's not going to change our views.
Yeah, I mean, we'll see. But I appreciate that gentleman. I really do appreciate him. I appreciate him because at the end of the day, these big companies also listen to him. I love these companies to go more into detail in future conference calls and presentations over 2026 about their business model, the economics, like why they're doing this, like more in depth. So although I can disagree with him in a lot of respects, I also applaud him for putting the pressure on, right? So yeah. Alrighty, next up here, let's talk about some stocks I'm looking to buy, including some new stocks here, okay? So what we're looking at is my possible buys watch list. This is my full possible buys watch list here. I have Amazon, Bath & Body Works, Salesforce, PayPal, Nike, The Planet, RH, Kava, Meta. Man, RH is all the way down to 141 now. American Express, Adobe, Google McDougal, Whirlpool, Elf, Chipotle, Cake, Celsius, Estee Lauder, Honest. Okay, so there's 3 stocks that I'm really looking at to potentially buy as my next stocks when I'm talking about brand new positions that I'm looking to start in. If you're wondering like when would I start these positions, I would start these positions likely January or February. Okay, and so for the remainder of this year, which there's not much of this year left, keep in mind we got the holidays that's going to be disrupting trading days. There's only I think there's only 30 trading days left in this year. Like this year is almost done at this point. So I'm already on to 2026. Like 2025 is a thing of the past for me now at this point in time. So in terms of some new stocks I'm looking to buy, I'm looking at RH. RH is a stock that I think if anything is going to go lower between now and year end. It's going to be lower than 141. Continuing to see tax loss harvesting that one. No one wants any piece of RH right now. And I wouldn't want a piece of it either right now. Like, talk to me in 2026. That's what I'm definitely looking at. I like that company for the long term. I hate what they did with their balance sheet. I need to see their next earnings. If their next earnings say, if the balance sheet's improved a bit, if their cash balance is built up a bit, that will give me some more comfort. And if they're profitable on the bottom line, that will give me some comfort as well. So I need to see that. The conference call will be what the conference call is going to be. But, if this market goes a little more south too, and let's say those earnings aren't everything as cracked up to be, you'll see that stock at 99. Kava. This one I've always kind of pictured going under 40 or right around 40, in December essentially. So that's what I'm looking at starting a position in. I really like Kava. I ran numbers recently. So on 1000X, we have a bunch of different things you can do on here that's very valuable. But one of the most valuable things is being able to run projections on companies. So I saved my Kava projections here. We made it so now you can save your projections when you're done and then load it up so you don't have to keep running the same projections on the same stocks again. But I've ran projections on Kava and it looks pretty darn good. Like if my base case works out here, which is 20% revenue growth on average, 26 through 29, and 35% net income growth, you could say a 60 to 80p would be fair for a company growing at that sort of growth rate, right? Like you're looking at a CAGR that's 30% plus here, right? So now you could take that down a bit. So here I did 15% revenue growth, 20% net income growth, 40 to 60 PE ratio, which is pretty fair for a company growing at those sorts of growth rates, because we're talking about this is about a 3x of the market in general. And the market in general usually trades at a PE in the 15 to 20 range. So that's nothing crazy here. Even in a bear case like that, I still get between a 4 and 15% CAGR over, the next 4 years, even under a bear case assumption. And then the bull case assumption plays out. Revenue growth of 25% per year, net income growth of 40%, gets their net income to 282 mil, by 2029 and revenues of $3 billion, right? We're talking about, and this is net income margin 9%. This would be a CAVA a little more mature at that particular time. We're talking about a CAGR of 40% plus, which is pretty darn compelling. Now, to compare that net margin there, 9%, compare that to like a Chipotle. I think this is very important. We'll pull up the compare feature here. I love this feature. You can compare 3 stocks side by side. So Chipotle, and then let's pull up CAVA here. And so if you look at the net margins of Chipotle, 13%. So to assume CAVA gets to like a 9% range, and their net margin's a little messed up right now. Keep that in mind in regards to CAVA. But to assume CAVA's at like a 9% net income margin or 10% even come 2029, I don't think that's crazy to assume at all, to be quite honest, right? Chipotle's shown you can go to 13% when it comes to their net margins, if not a little over 13%. So just something to kind of keep in mind there in regards to that particular stock. Now, another stock I'm thinking about starting a position in 2026 is right here, Bath & Body Works. Bath & Body Works, like boring business. We all know that, right? But this is one I'm really compelled with. I ran the numbers on this stock the other night and I was like, are you kidding me? Like, this is pretty darn attractive here. There we go, Bath & Body Works. Watch this. So oh, dang it, I didn't save my other cases here. Shoot. But I ran them at a 5% revenue growth per year, 7% net income growth, right? And we're talking about you could get a CAGR in the stock between 25 and 37%. Dang it, I meant to save my other cases as well. Well, anyways, I'll do that later. But Bath & Body Works is actually a pretty compelling stock. Now, as far as stocks I am already positioned into that I want to buy more, right? Meta's even looking like a deal now at this point in time, but Amazon continues to be one that's going to be a huge focus for me as far as buying, right? I like Honest a lot still. I like Estee Lauder a lot still. I even actually like Fubo. I need to add Fubo to this list as well. This is one I was taking a break on buying, but now that the deal's done, that took a lot of risk off the table in regards to Fubo. So Fubo is one I could continue to buy some shares here and there. It's a little more speculative. If this stock, if their margins start to increase quite dramatically in 2026 and if they turn to profit, like real profitability, now that the Hulu deal's done, if they do that in 2026, this is no longer going to be a spec stock anymore, which means I could actually buy this one pretty aggressively, right? EL continues to be a buy. I know it's gone up a lot from those lows it was back in April, but that continues to be a buy. Cheesecake continues to be a buy. Like Cheesecake looks phenomenal at $44 there. Celsius is a buy. Chipotle I've considered potentially starting a position there. Yeah, I mean, I might do something in regards to Chipotle. So I don't have Chipotle numbers here for good old CMG. But if we just ran, I mean, what would be a conservative number for Chipotle over the next few years? Like 5% revenue growth maybe. And let's say maybe like 7% net income growth for Chipotle. Let's say they're much slower growth. And you could say a 20 to 25 PE could be pretty fair for Chipotle under this sort of situation, right? Which is considerably under what they've been getting in the last many number of years. But keep in mind, growth might be slower. Nope. Yeah, Chipotle's a no for me. Let me just delete that one. Chipotle. Whirlpool's interesting. That could be a huge turnaround play if housing gets moving actually in 26, 27, which I assume 26 will be better in terms of amount of people moving than 25's been. And then I assume 27 will be better than 26. And I assume 28 will be better than 27. So Whirlpool could actually be a fun stock to be in from like a multi-year perspective. And Mr. Appaloosa Management, I think David Tepper's been buying a lot of Whirlpool. I think he owns, I want to say $300 or $400 million of the stock now at this point in time. ELF continues to be a buy here. American Express, really love American Express here. I believe I have my American Express projections saved here. Amex, there we go. Let me show you these babies on this one. So here's why American Express is so exciting. It's one of the safer business models you can really invest in my opinion, in the stock market. And under my base case here, I get a CAGR of 20% plus. You know, like, it's hard not to buy that stock with a CAGR, we're talking, 20%ish range for a base case, for a stock that has that level of safety, right? There's one thing if it's a very dangerous stock and things could go really bad for them, but I mean, look at even from my bear case on Amex, I still get a return that will probably be in line with the S&P 500, if not better. Ladies and gentlemen, that means that stock is a buy, right? CRM continues to remain a buy. I don't know if I have updated CRM numbers that I've done here in regards to that one. Let me see. These might be old numbers. Let me take a peek here at Salesforce. Oh no, these are pretty normal numbers. I had them doing revenue growth of 12%. I think they're actually going to be a big beneficiary of AI because of some of their new products they have, and they just did an acquisition that should be closing. That's going to boost up growth very nice in 26 for this company. And I think their net income, it looks like, Benioff's going to lead that company very lean. So I think their net income will go much more rapidly than revenues are going up. And so this is another one I think could CAGR about 20% clip over the next 4 years. So I really like Salesforce here. A stock that's kind of hated, but I think it's a buy. And PayPal, huge buy. PayPal, yeah, let me see my PayPal projections here for you guys. So load data for PayPal. And what do we find? We find my base case for PayPal. I'm getting between a 21 and 29% CAGR under my base case assumptions for PayPal. Pretty attractive, right? Pretty darn attractive in regards to PayPal. So that's another one that remains a buy. Let's get into Tom Lee.
Broadly, with your kind of high-level view here, what do you think is really going on? Tom, let's start with you first.
Well, Leslie, I think the markets are a bit nervous in crypto land and equity world because, one, we've had a government shutdown, and then there's been doubts about AI valuations and people raising questions about that. So AI stocks have corrected and many growth stocks have corrected. And then in crypto specifically, it's been dealing with two issues. One is there was this big liquidation event on October 10th, one that really was a larger liquidation event than anything seen in history. And the second is because crypto is risk on, I think markets are really struggling with what the Fed's going to signal on December, because, if you end up with a hawkish Fed, it gets crypto investors very nervous. I think that's all creating this downside pressure. But I think the good news is there are signs of exhaustion. I did speak with Tom DeMark of DeMark Analytics, and he thinks there are signs that would look like a bottom that could be occurring sometime this week.
Matt, do you agree with Tom here?
I actually do exactly agree with Tom. I think we're nearing a bottom. I look at this as a great buying opportunity for long-term investors. Bitcoin was the first thing to...
Hold on. Okay, listen. Now, Tom Lee and this gentleman, I'm pretty sure they're very heavily exposed to Bitcoin and Ethereum, right? But you got to understand, if you look at the Bitcoin cycle, the Bitcoin cycle says Bitcoin is not going to bottom until late 2026. Who knows? I'm not going to play Bitcoin from the short side or the long side. I have no interest. All I'm stating is that's something to consider there. And from what I've seen as far as the projections go for that Bitcoin cycle, right, it has gone all the way down to 30K. So I don't know, who knows what will happen with Bitcoin. What I can tell you is very important from the stock market perspective, Bitcoin is, because people look at Bitcoin as a risk-on asset. And a lot of times if Bitcoins continue to move down, they don't want to take any risk, right? Which leads to just a lack of wanting to take risk in the stock market as well. So that's something to consider. Also, you can get margin calls in there. I also don't like how many people are calling for a bottom on Bitcoin and Ethereum already. I'm like, geez, you know what I mean? That's a lot of bottom calling there. That's a lot of bottom calling, but it is what it is.
Turnover before this broader market pullback. It was sort of the canary in the coal mine, signaling that there was some risk in all sorts of risk on assets. I think it'll be the first thing to bottom, and I agree with Tom. We're getting very close to that point. So I think it's an exciting opportunity, again, for people who are looking out a year or more into the future.
Tom, kind of digging into Ethereum a bit more, what do you think are some of the idiosyncratic drivers here? Are there things that you think may be due for more of a decoupling from just the broader risk environment or crypto as well?
Well, Ethereum is a smart contract platform, so it differs from Bitcoin which is a store of value. And in many ways, its virtue is that it's inert, and it represents digital gold and a good store of value. Ethereum, on the other hand, is because it's a smart contract platform, is really the rails where I think a lot of things are going to be built. And one of the big breakouts this year has been stable coins, but it's also been things like prediction markets, and now talk about tokenizing more than just dollars, but equities and real estate and alternative assets and other assets. And a lot of that will be built on Ethereum or layer 2. So I think from a perspective of what the ecosystem looks like, Ethereum is a place where there's a lot of activity taking place, and you can measure it by transaction volumes or transactions per second or even value locked on the chain. And these are all rising. So to us, I think it's a story that still is in the earliest stages, and one of the reasons we consider it a super cycle.
And Matt,
before we go further here, one of the other reasons it's so crazy, these guys are trying to bottom call already on Bitcoin, Ethereum, and think it's just going to go up from here, is whenever you're thinking about a bottom forming for the stock market, a bottom forming for stock in general, or crypto for that matter, okay, you need to see something very important. Always keep this in mind for the future. Everybody that's watching this right now, listen. You need to see that stock, that crypto, the market or whatever in general, do a bottoming formation, essentially, right? So for instance, right here, Bitcoin made like a bottoming formation. So you could make an argument that Bitcoin, was basically in a bottoming phase here because, it had gone down a lot, but it was kind of like it was starting to bounce and whatnot. As of right now, at least, we see no bottoming formation in Bitcoin or Ethereum right now. Like, it is just straight down as of right now. If you can start to have Bitcoin come back and then kind of stabilize, maybe go down a little bit more and stabilize, then you could, I think, make a strong argument that, okay, we've reached the bottom. But as of right now, like, these babies have not shown any signs of forming a bottom yet. That's just something to kind of keep in mind there. And that's why I think it's like, very just loosey-goosey to just be like, oh, we're at a bottom or we're bottoming this week or something like that.
You agreed. You said that you agree with Tom that it's nearing a bottom. How much of a long-term buy do you think this is?
I think it's a generational opportunity for long-term investors, whether you're looking at Bitcoin, Ethereum, or Solana. To double down on what Tom said about Ethereum specifically, look, I think investors are very nervous broadly about the economy.
Dude, Bitcoin's not even down that much. Generational buying opportunity, it's just so ridiculous. Like, generational buying opportunities are when you're getting an asset that's at 5, 10, 20-year discounts. Okay, that's generational buying opportunity. 2022 was a generational buying opportunity for, you could say, Bitcoin. Bitcoin went down to 15,000. It was a generational buying opportunity for tech stocks. I mean, you had many of the best tech stocks in the world all down 70, 80, 90%. So like all over the place. Nvidia was down 50%, like Meta was down 70+%. Shopify, Netflix went down like 70, 80%. That was an actual generational buying opportunity. The great financial crisis, that was a generational buying opportunity in terms of the market in general. Like, you have some of those time periods. Bitcoin's not even down that much. Like, are you kidding me? Like, Bitcoin is not even down that much. What are we talking about here? Yeah, a generational buying opportunity. And obviously these guys are so exposed to this stuff, so they have to. But dude, Bitcoin's down 1% for the year. 1%. 1%. Generational buying opportunity? What? On a 1 year, Bitcoin's up 2%. Generational buying opportunity? It's just ridiculous, man. In the past 5 years, Bitcoin's up 403%. Generational buying opportunity. Whatever, man. And the craziest part is that you don't even have fundamentals to back it. It's not like a stock where it's like, okay, this company has this much earnings, it's trading at this PE ratio, the earnings are likely going to increase by this much per year. It's just crazy, man. This is crazy stuff.
About AI valuations, about tariffs, about the broad economy. You want to look for secular trends that are decoupled from that. I think regardless of what happens on the economy in the next year, stable coins will grow tremendously. I think regardless of what happens, tokenization will, maybe 10x in the next few years. Prediction markets are going to be huge. Decentralized identity and digital identity are going to be huge. Ethereum lets you play those secular trends, which are in this enormous growth phase.
So that doesn't mean Ethereum's like directly benefiting from all that stuff. Like, what are we talking about here?
almost regardless of what's happening.
Some stuff it'll benefit from, not everything.
For me, it's really it's a generational opportunity, and to get in at these prices, I think really is almost a gift for long-term investors. It's a tremendous opportunity.
To get in at these prices, it's down 1% for the year. It's up 2% in the past year. To get in at these prices, has this guy never seen a generational buying opportunity before?
Tom, in terms of just the overall volatility, what are some of the near-term headwinds you're expecting Ethereum to face?
Well, one of them is the industry did suffer a big liquidation event that I think crippled many players and wiped out many accounts. So I think that this, just like in 2022 or in 2020, it does take a few weeks for the industry to sort of find its footing. And I think that's why crypto prices have lagged here. And it does have the signs of that maybe a market maker or two is unable to provide market liquidity. And as you know, as liquidity contracts, it's the same thing as the central bank tightening. So it's almost like crypto QT. I think the other thing the markets are grappling with is people talking about the 4-year cycle. Many are convinced that Bitcoin prices have peaked. So in some ways, Bitcoin being the blue chip and the bellwether is important for crypto, because if Bitcoin makes a new high this year, then it really obviates the fact that there is a 4-year cycle. And so it's, to me, between now and year end, I'm pretty bullish on stocks. This sort of weakness in the first half of November was what we expected. But as markets rally, I think that's going to help propel Bitcoin to an all-time high.
Tom, we can't let you go without asking about Granny Shots. That ETF recently celebrating its 1-year anniversary, gathering $3.6 billion in assets in its first year. You plan to expand the lineup. How do you plan to do so, and where else on the court will you be shooting from, so to speak?
Yeah, well, that's right. Granny Shots, which refers to a way of shooting free throws, proved to be very popular with investors, as you point out. And part of it is the performance. Granny Shots in its first year outperformed the broader index by 1,000 basis points, and year to date beating the S&P by more than 1,000 basis points. The idea of Granny Shots is the idea that there are super cycles, themes that last for more than 5 to 10 years, and we want to buy the strongest stocks. So we are expanding the Granny Shots family. That they're going to go effective tomorrow. One is a mid-cap Granny. So this is taking the same Granny model, finding the 7 super cycle themes, but buying small and mid-cap stocks. And it's going to hold more names, maybe 40 to 50 names versus 30 for Granny. And this is going to be a good way for investors to get additional Granny exposure in small and mid. And the second is an income-oriented Granny Shots product. So this is going to be using the same Granny Shots model, but also generating income. So the tickers are GRNJ for small mid-cap and GRNI for the Granny income.
So I'm excited to see, how Tom Lee does over time in regards to those ETFs and whatnot there. Specifically, obviously, for his main ETF. And the reason being is, obviously, he's done it for a year now. But at the end of the day, it's been a great time in the market the past year. Fidelity recently had us on a 1-year return of 40 or 50% or something insane, right? So it's been a lot of fun. But the other thing is, how do you handle the bear markets, right? And so that's what we haven't seen with his ETF. How does it handle the bear market, right? I love to look at my 5-year returns, my 10-year returns. That lets me know how I'm doing over time, because, if you're in the market over 5 years, good probability you'll have at least one bear market in there. If you're in 10 years, you probably have 2 bear markets to go through. And then you get to understand, how are you holding up in general, not just on a 1-year basis, right? Because, if you're in higher beta names, higher risk stuff on a 1 year and the market goes up a bunch, you're probably going to go up even more, right? So there's something to kind of keep in mind there. Once again, that 1000X sale is going to be the pinned comment down there to sign up for the sign up list. And when you join us in there, we're going to send you your Steel membership card when you get that deal. We're going to have a deal on the 1-month membership and a 3-year membership, depending upon how long you want to join. And that is 9 days from now. It's coming up fast. The ground beneath the stock market is shaking like a very small earthquake now at this point in time. The NASDAQ, from its recent highs, is now down about 6%, but it's so much more extreme than what you see at the index level at this point in time. Look at some very popular stocks on YouTube, on X, that are talked about a lot, and you're going to see severe damage in these stocks. Look no different than Duolingo stock. Very popular stock out there. In the past 6 months, this stock has fallen 66%. 50%. Oh my gosh, look at HIM stock. It is down 50% from the highs it reached just this summer now at this point in time. Look at Palantir. Palantir came out with unbelievable earnings, one of the best earnings reports you probably have seen this entire year from any company. And despite that, over the past 2 weeks, Palantir stock is down over 18 percentage points. Robinhood stock, which that company's fundamentals have been incredible. That stock since Halloween has lost almost a quarter of its value. Seems like Halloween was just yesterday, right? It's lost almost a quarter of its value, down over 24 percentage points. We have an unbelievable divergence between Bitcoin and gold going on. Bitcoin is now negative, ladies and gentlemen, for the year in 2025, while gold's sitting on over a 50% gain. But look at what has happened really over the past 2 months. There's been a clear divergence where it was Bitcoin was winning this race this year, and suddenly gold took a massive leg higher, while Bitcoin just absolutely has fallen quite substantially over the past month and a half to 2 months now at this point in time. Now, if you've been watching my content for months and months, you know I've been speaking countless times about how this reminds me of 2018 this year. It's just an inverse. 2018, we had a small fall in the early part of 2018 and a large fall at the end of 2018. This year is reminding me of the same exact thing, just an inverse, where this year we had a huge fall earlier in the year, and then we're going to get a smaller fall essentially at the end here of 2018, and it's playing out exactly how I thought it was going to play out. Now, in this video here today, 2 core subjects we're going to speak about, okay? One is, am I scared we're about to go into a 2022 where we're going to see this NASDAQ fall 35% plus? Where this is going to become severe damage out there in the market, from like, ooh, it was, just speculative stocks were falling to like, oh no, the whole market's going to go through a massive crash here. Okay. We'll speak about that at the beginning of this video. Then from there, I want to get into 10 stocks I bought here today, why I bought those particular stocks. Those are the 2 subjects we'll cover in this one. This is an absolute banger of a video. I've been prepping this all day for you guys. I hope you really enjoy this one. There's one thing and one thing only I need from you guys. And if you could just hit that little thumbs up icon, that's all I need from you. I appreciate every single person that's already done that for this video. And if you haven't, please help a man out. I've been prepping this all day for you guys. Additionally, make sure you subscribe to the channel. If you like to see my videos, you want to see more of them, make sure you're subscribed. Higher probability YouTube will show my videos to you in the future. If you're subscribed, lower probability if you're not subscribed here. Okay. Also, one piece of housekeeping here. We have a massive sale coming up for 1000xstocks.com, Black Friday. Very proud to announce that deal. We're going to have it on a 1-month membership and a 3-year membership is what the deal will be for that. So pinned comment down there. Click on that, put in your name, put in your email, and you might want to put in your phone number. Every year we do the Black Friday sale on something. Sometimes we'll do it on Patreon, sometimes we'll do it on 1000x, right? Every time we do that deal, once a year, people will enter in their email wrong, or they'll enter in their email and then they'll have missed the sale because they get a million other promotional emails on Black Friday. Like, this is the deal you actually want, okay? So you might want to put in your number as well so we can text over the deal when that does drop on a Black Friday. Additionally, when you receive the deal, we will send you your Steel membership card in the mail to your house, apartment, condo, wherever you reside at. Okay, so that's going to be very, very exciting. That is, if you're not part of my private stock group, you have to have 1000x. It is absolutely key. Okay, one thing, if you don't want to be part of my private group, like that's too much for you or something like that, 1000x, you gotta have this. So every single person watching this video, you need to be signed up for that deal. It is well worth the price of admission. I can tell you that much. Okay, alrighty. Number 1 here. Am I scared we're about to enter a 2022? Well, you got to understand, in 2022, the market fell. And then as terms of the NASDAQ, it fell high 30%. I think it was like 37.8% or something like that, peak to trough. Okay. Now, the thing you got to understand about that drop that year was that was the most severe drop we had in the NASDAQ in terms of duration and downside move since the great financial crisis of 08-09. The great financial crisis, from the peak of 07 to the trough in early 2009, the NASDAQ fell just over 50%. And that was a severe, we can call it about a 1.5 year long crash, if not a little over a 1.5 year. Brutal. This was almost as brutal, where it lasted around a year and we fell about 37%. So it was quite severe. And so just understand, those situations where you're talking NASDAQ down 35+% over a period of a year doesn't happen very often. And when it does, you better take advantage, because that is few and far between in regards to that matter. Okay, now, that you got to understand why the market fell in 2022. Because there was a few reasons, but I'm going to show you the biggest reason. Okay, so if you're wondering, like, are all these big tech stocks about to crash huge like they did in 2022, where you saw a ton of them go down 40, 50, 60, 70, 80%, right? You got to understand why that happened. Look at a company like Meta, for instance. This is my biggest investment in the public account, okay? And the stock I bought heavy in 2022 as it was crashing. If you look here, Meta coming out of Rona, right, was showing unbelievable accelerating growth from 21% to 33%, 47% revenue growth, 55%. You have to understand, when it comes to big tech stocks, growth stocks, people buy these companies for the revenue growth. Margins are cool. Profits are cool. Customers are cool. Other metrics are cool. Valuation is cool. Revenue growth is king when we're talking big tech and we're talking tech stocks in general. Revenue growth is king. So what happened is Meta's revenue growth decelerated substantially from 55% growth in the summer quarter down to the September 30th quarter, 35%. Now those results, keep in mind the quarter ended September 30th, but the results actually came out right when the market peaked in that Q4 2021 timeframe. They were right around like November-ish, okay? And guess when the market peaked? Right around November 2021. So here we are, we're in a situation where the market peaks right as Meta's growth rate decelerates off a cliff, right? We're talking about when you go from 55% revenue growth down to 35%, people are like, that's such a massive deceleration. They start worrying about what's next quarter going to be if it's decelerating that rapidly, right? And then what happened with Meta? They came in with then 19% revenue growth, then 6% revenue growth, then their revenue started to go negative, ladies and gentlemen. And so if you're wondering, how did Meta stock crash 70%? Listen, the Zuckerberg spend on the metaverse and all those things and what happened with their margins, profits and all that, it mattered. But it all pales in comparison to what happened with the revenue. That's why Meta stock crashed. When you go from growing revenue 55% to your revenue goes negative, your stock is going to get obliterated. And that's exactly what happened with Meta stock. It fell 70+% in that crash. Unbelievable fall, okay? Now, was it just Meta? Well, look at this. I think this is very important. Oh my gosh, this is so important. I show you what's going on right now, because if you're wondering, is this occurring with Meta right now? And is this occurring with tech stocks? Let me show you this, because it's very important before we move on to the next stock, okay? This is extremely important. Listen. What we're seeing with Meta right now is not revenue growth deceleration. We're seeing revenue growth acceleration, okay? So the growth rates are getting stronger. It went from 16% growth to 21% growth to the latest quarter, 26% revenue growth. So we're in a revenue growth acceleration phase right now. We also aren't coming off of some weird situation where growth rates looked insanely strong because you came off of Rona. We don't have like stimulus check money that you had in that whole back situation back in 2021. You don't have any of that you're dealing with, okay? And so do keep that in mind. If Meta's revenue growth starts to decelerate in any substantial way, then we can have a problem with Meta stock, right? But is Meta stock going to go from 26% revenue growth to, negative revenue growth over the next few quarters? I don't think there's a very high probability of that. I think if anything, Meta's going to keep in that 20% plus range for quite some time. Best case scenario, maybe they push it up to like 30 or 35% or something like that. So we just don't have the same ingredient when it comes to that, okay? Now, look at Shopify stock. Shopify stock is a perfect example of a stock that got absolutely obliterated in that crash. It fell 80%, ladies and gentlemen. That stock went from like $150-something stock down to like $25 in the summer of 2022, right? Here's what happened with Shopify. They went from revenue growth of 97%, 96%, 93%, 110%, down to 56%, then down to 46% in that peak period. And then they kept decelerating down to 41% growth, 21% growth, and at the lows, 15% revenue growth, okay? And so if you're wondering, why did Shopify stock fall? That's why Shopify stock fell. The revenue growth was insane. And then it was like, oh, this is good, but this isn't what it was. And then Shopify had an insane valuation on it at that particular time, right? Look at Netflix. Netflix stock fell over 70%. What happened with Netflix? Well, look at this. 2020 and 2021 into 2021, right? They were growing revenue consistent in that 20% range. So people thought of Netflix as like, oh, it's a company where it's going to be able to grow 20% a year. Like, we're good, right? All of a sudden, what happens? Right as the market was peaking, revenue growth decelerates down to 16%. Then they put up another 16% number, and then down 9%, 8%, 5%, 1%, right? That's why it happened. It's not like the 2022 downfall was just this or that. It's because all these companies that matter the most to the market, all these tech companies, had very high valuations, and their revenue growth went from like insane to like they're barely growing, or their revenue started to go negative. Look at Nvidia. Nvidia is one of the best examples of a shocking fall in that stock and what happened with the business model. The stock fell 50%, but that doesn't even show the most insane thing that happened. They were growing revenue 61%, 83%. Look at this quarter in 2021, 68%, 50%, 52%, 46%. And they went from 46% revenue growth down to 3% in a quarter-over-quarter basis. In a quarter-over-quarter, 46 to 3. You know what happened the next quarter? Negative 16% revenue. You know what happened the next quarter? Negative 20% revenue. Unbelievable. What happened with Nvidia's business model? Did Nvidia deserve to go down 50%? Honestly, when you go from 50% plus revenue growth down to negative 16, negative 20%, yeah, Nvidia deserved to fall. Maybe, honestly, you probably should have fell even more than 50% in that situation. Now, if you had a longer term vision and a longer term horizon, Nvidia was an incredible buying opportunity in 2022, right? But at the same time, like, you got to understand, it didn't fall for no reason. It fell for a great reason, right? Now, this next point I got to bring out, very, very important, okay? Listen, AMD. AMD also fell in that 2022 crash as well. AMD stock got hit hard. And you could make an argument that AMD was actually putting up more impressive numbers than Nvidia in 2022, but that didn't mean the stock didn't get hit. It got hit as well, 50+%, right? Just like Nvidia did, okay? Now, if we're going to look at the biggest 15 companies that matter the most to S&P 500, what are we likely to see in 2026, in my opinion? Accelerating growth or decelerating growth, okay? In terms of the revenue growth they'll put up in 2026 as a whole for the year versus a whole for 2025, is that growth rate going to accelerate or decelerate? Well, here's what's going to happen. Nvidia, no question, they're going to decelerate. Anybody that knows anything about Nvidia's business model all knows revenue growth will decelerate, in 2026 versus 2025. There's no question about that, right? Apple's likely going to have an acceleration of revenue growth in 2026, and that's really because this iPhone generation is selling really, really strongly for them. Microsoft will likely have an acceleration as well because of their cloud side of the business, their Azure business. Amazon will likely have an acceleration of growth as well because of AWS specifically. They're also pushing hard into grocery, so I wouldn't be surprised if grocery growth rates are very, very strong for them next year. But that AWS growth now pushing 20% plus, that's going to matter significantly. Google, I would say, also accelerating as well because of cloud business as well. Broadcom, acceleration as well because of the custom chips there. Meta looks like they'll accelerate revenue growth in 26 versus 25 as well, because if you see the trend on where revenue's headed, like, it looks pretty darn good. I think Tesla's questionable. I don't know if they're going to accelerate or decelerate growth. Berkshire Hathaway, same exact thing as far as their growth rates next year versus this year. Questionable. Eli Lilly, questionable. Walmart, questionable. JP Morgan, questionable. Visa, questionable. Those are all like, I don't know, I can see it going either way. Oracle is going to accelerate growth as well, quite substantially next year versus this year. So overall, we don't have the same dynamic going into 2026 that we had, when we were going into 2025, where basically you could run through almost every company and say they're about to have major decelerations of growth rates in revenue. We just don't have that. We have the substantial amount of these companies is going to be accelerating revenue growth. And almost no one's going to be decelerating growth other than Nvidia, right? And Nvidia's still going to put up amazing numbers. They're going to still put up amazing growth rates in 2026. It's just, it's going to be at a slower pace than obviously what they did in 2025. But we don't have the same setup, ladies and gentlemen, okay? Now, additionally, look at a stock like Oracle, because I remember I talked about Oracle here at the end. They're going to accelerate growth. This one's pretty crazy. Since they made their OpenAI announcement on September 10th, 2025, right? The stock has lost all of its gains and then some. It's now down 36% from where it was after that announcement came out. Like, what a shocking fall in regards to Oracle stock, right? Now, AMD, we didn't talk about AMD in regards to top 15 because it's not a top 15 company, but it's a little outside of that top 15, right? And still one of the biggest companies that matters, one of the most to the stock market, right? You got to understand with the AMD, they're about to go through a major growth acceleration phase in 2026 and then into 2027. So you're likely going to see revenue growth accelerate substantially in 26 and then accelerate again in 27, which is pretty special. And so you got to understand AMD is a very important stock to the market nowadays, not because of its market cap, although that's pretty big as well. It's like a $400 billion market cap, right? It's not big compared to these other companies that are several trillion. It's very important stock to the market from the respect of like people that are growth investors look at a stock like AMD. And if AMD stock price is doing well, people feel good about the market. If AMD stock price isn't doing well, people aren't feeling very good about the market, right? And so just understand like AMD sets up phenomenal for the next 24 months. And I think that's another reason why it's going to be hard to, get this market down in any substantial way when you got a stock like AMD that's going to be running heavy this next 24 months, right? Now, additionally, you got to understand what we had in 2022 outside of the thing that mattered the most, right? People will say this, what I'm about to show you right now, mattered the most. That's people that don't know the market very well. Okay, the thing that matters the most is always big tech and growth rates. Those are the companies that matter the most. The next thing that matters after that is what's the Fed up to? The Fed is very important, right? Not the most important. If all these big tech companies, revenue growth, all starts to decelerate substantially next year, it doesn't matter if the Fed's lowering, raising, it doesn't matter what they're doing, the market's going down. On the flip side, you look at the Fed still going higher in 23 with the Fed funds rate. The Fed kept taking Fed funds rate higher in 2023. And yet what happened with the market? It went phenomenal. You know why? Because big tech outweighed all that. Big tech started accelerating growth rates again, and everybody started buying the market. This shows you big tech is more important than the Federal Reserve nowadays, ladies and gentlemen. Okay. Now, in regards to what we had to deal with in 2022, another part of that was the Fed kept raising rates aggressively, right? So in 2022, you had to fight the Fed. Right? Now, you also had to fight the Fed in 2023 and you won that fight. But in 2022, you didn't win that fight, right? Are we going to have to fight the Fed in 2026? The answer is no. We're not going to have to fight the Fed. The Fed's going to likely be lowering rates in 2026. And so we don't have a fight the Fed situation going on, right? Now, additionally, you got to understand there's some things that are happening on the government side that are quite substantial. One is this. Have you heard of the BBB? We're talking about the big, beautiful bill, okay? The big, beautiful bill that was passed this year. Now, what does it mean for this year in terms of 2025? A whole lot of nothing. All the really positive effects that are going to come from the big, beautiful bill start to hit in 2026, okay? So this is quite substantial. And so if anything, that's going to add some fuel behind the economy, the markets and things like that in 2026 and beyond. So do keep that in mind. That's just about to start to hit, okay? Additionally, T-Man is talking about $2,000 tariff dividend checks coming by mid-2026. We'll see if that does happen. That could be definitely a very bullish thing for the economy, a very bullish thing for companies. We know if you give people $2,000 stimulus checks, you know what they're going to do with that money? Do you know what the majority of people are going to do with that money? Unfortunately, they're not going to invest it. And unfortunately, a lot aren't going to pay down debt either. You know what they're going to actually do with it? They're going to go buy new iPhones with it. They're going to go buy new stuff on Amazon. They're going to go spend the money in the economy. They're going to go buy new Nikes. They're going to go to the mall. Like, it's just humans, man. It's just humans. Like, I don't know what to tell you. Like, if everybody was, super financially responsible, like, everybody would be sitting on, tens of thousands, hundreds of thousands of dollars or millions of dollars in net worth, right? And that's just not the situation. Like, far majority of individuals out there, basically have no net worth of any significance at all, right? And it's because you give them money and they're going to find a way to spend it, right? And that's exactly what will happen. Like, they'll use it toward a down payment on a car or something like that. And so it would be a huge boost to the economy. There's no debating that, right? Now, there's also worries about that could fuel inflation in 2027 and after, and that's a possibility, okay? But the bottom line is things like the big, beautiful bill, and then if you do tariff dividend checks, $2,000 to the massive amount of Americans, like, it's going to be bullish for the economy and bullish for the market, right? There's no debating that. So the moral of the story is we just don't have the ingredients for a 2022 type meltdown of a 35% plus drop in the NASDAQ. We had all the ingredients for that sort of big drop in 2022, and we got it. You had the Fed working against the market while all the big tech companies' revenue growth completely died and started to even go negative, right? It wasn't even that they were decelerating. And some of those companies I just ran you through, their revenue started to go negative, right? And also you had nothing really positive from like stimulus checks anymore at that point in time, or like, things like the big beautiful bill. So like you had the ingredients to get a massive downfall in the market. You just don't have that now at this point in time. Okay. Now, in regards to what about this drop we're having here at year end, like how much further could it go or not go and those sorts of things, right? Well, remember, like I said at the very beginning of this video, we had a major downfall at the beginning of this year, which is not the same as 2018. 2018 was small fall earlier in the year, massive fall late in the year. I think we've got the inverse going on, where we're going to get the small fall here at the end of the year where we already had the massive fall this year, right? Now, in that fall, and when I say fall, I mean like literally the market going down, right? In that Q1 like drop in the market in 2018, the NASDAQ fell about 10%. That's exactly what I'm expecting. I'm expecting a 10 to 15% drop in total for the NASDAQ. We're already at about 6%, so you can say we're already over halfway there, around halfway there right now, okay? And so that's what I'm kind of expecting in regards to this. Now, am I going to wait to buy until like, exactly when we hit 10% down or 12% down? No, because we might not. Like, what if today was a low? Did we consider that? Like, that's a possibility. You can't ever bank on absolutes in the market. Even when you're investing in stocks, you can't ever bank that you're for sure right? That's why I stay diversified. If I was like, if it was as simple as like I ran projections on a stock and this stock said I was going to get the highest CAGR of any stock, then you would say I'd just go all in that stock. Why do I not do that? Well, because guess what? That might not happen. So you can't bet on absolutes in the market. That's why you stay diversified. That's why you go through a range of outcomes that's possible. You might think, okay, this stock's a great opportunity, so you invest into that stock, right? But it doesn't mean you go all in. I might think like we're going to probably drop in that 10 to 15% range before it's all said and done here on the NASDAQ from recent highs. But that doesn't mean I'm going to bank on that and like I'm going all in right when we hit 10% down, 15% down. Like there's a range of outcomes. We could go down way more than that. We could reach the bottom today or this week. Like, you know what I mean? And we never even hit a 10% down. Like all those are possibilities, right? Now, additionally, you got to understand what is occurring here is very good and healthy for the market, and we need this in the worst way. People think like, oh no, just the market needs to go up every day, every week, every month. No, ladies and gentlemen, we need this in the worst way, what's going on right now. Listen, margin got out of control recently, okay? Almost $1.2 trillion out on margin here in this latest month from what we had back in October, right? The margin's been going insane. People are taking out margin like it's nobody's business and loading up on stocks. In order to clean up that margin mess, you have to have the market get hit. And not just the market. You have to have the stocks that people like to margin out on. Usually what people like to margin out on is stocks that are usually high growth, more speculative, more retail trader type names. So by having those stocks drop 30, 40, 50, 60, 70%, you're going to get rid of a lot of that margin speculative activity of people just going crazy on that. You have to flush it out, man. It has to be done. Like, I don't know another way to put it. It has to be done. And so we're at that situation now at this point in time, which is very healthy. Like, we got to get rid of this margin and this amount of speculation out there in the market. And additionally, this is really big, ladies and gentlemen. We need to get the focus back on fundamentals, right? You got to understand, like, when you're in a very, very bullish market that just seems to go to the sky, people stop focusing on fundamentals. A lot of people, right? And they start like trying to make moves in the market that don't have anything to do with revenue growth, net income growth over time, what a fair PE ratio would be over time. They don't run projections, right? Like, we have 1000xstocks.com. We run all the projections. I run projections on every single one of my stocks. And I do not buy a stock unless the projections say this is a very good situation when I run my bull, bear, and base case for that stock. And what happens is when the market's really running hot, people stop focusing on fundamentals. They think they got some new hack. Like, oh, I'm going to pay attention to the trend of momentum, and I'm going to pay attention to blah, blah, blah. Like, they always come up with some new excuse on like something to focus on outside of just the raw numbers. And it always comes back to bite them. And so what's going on right now is needed. It's healthy, because I see some people out there and they're just not focused on the fundamentals. And that always ends badly. You don't focus on the fundamental. You think you got some new hack on the market. Guess what? You don't. I hate to break the news to you. You don't have some new hack on the market. You know, you make a lot of money in the stock market over time. Stay diversified, run your numbers on your companies, make sure you understand the business models very well. Buy when you're in when the valuation says buy, right? If you get a crash in the market or correction in the market, you better very much take advantage of that. It's the same old game. It's the same old game for the past 100 years, and it's the same game today. In the short term, anybody could throw anything out there. No different than, I live in Vegas. We go down the strip right now. You want to go to the win? We'll go to the win. We go play roulette, right? And I can go be like, I got some new strategy on roulette here. It's come up red 5 straight times, so now it's going to come up black 3 straight times. So I go bet on black and I hit it. I'm like, oh my gosh, I'm a genius. I found a new strategy to beat roulette. You just got to, go against the color it's been coming up. No, it doesn't work. And so what happens in the market, and I'm seeing a lot of people, they think they got some new hack, some new strategy, because we just been in a raging bull market without understanding, no, it always comes back to the fundamentals. And every time the market starts to get shaky, that's when people start to realize they're swimming naked out there, and they better get focused back on the fundamentals. So what's going on right now? This is needed in the worst way, right? On 1000xstocks.com, one of the great things you guys are going to get access to when you get that sale is this education portion. I would say a lot of people probably even watching this video right now, sadly enough, don't know how to do this stuff. They don't understand balance sheets on a high end, income statements, cash flows, how to perform SWOT analysis, strong moats versus weak moats on a business. A lot of people probably might not even know what a moat is, right? How to actually value dividend stocks, how to actually value growth stocks, portfolio management, all this stuff. Like advanced option strategies, basic option strategies. Like I'm sure there's a lot of people that don't understand that stuff, and it's time we get focused on that, ladies and gentlemen. The time period of like, I found some new hack on the market. I don't need to study on the market. I don't need to run numbers. I'll just throw money out there. Like that's over. It's over. It's long over, ladies and gentlemen. Okay. Now it's time to be the big boys and big girls and make some actual money out there. Okay. Number 2, what are some stocks I bought here today? Why did I do it? Okay. Well, first off, I did not get here by worrying about the next 3 to 7 weeks, the next 3 to 7 months in the market, right? Whatever is going to happen in the market short term is whatever is going to happen. This NASDAQ goes down 10%, or maybe it goes down 15%, 35%, 50%, whatever, okay? At the end of the day, that's going to be what that's going to be. I cannot control whether the stock market goes up or down in the short term, as you cannot control if the stock market goes up or down in the short term, right? I concern myself over the next 3 to 7 years. And by doing that, I'm able to live this lifestyle I live, right? If it wasn't for that focus over the coming years, I would not be able to afford the homes I live in. I would not be able to afford the cars I drive. I would not be able to afford the vacations I go to, like going to a restaurant. I don't have to worry about the price, any of that stuff. There's no way I'd be able to do this if it was like I was focused on the next 3 to 7 weeks, the next 3 to 7 months. No, I'm focused on years, ladies and gentlemen. Years, right? That's how you climb the ranks from a kid that was cleaning dishes in the back of Einstein Bagels for $7.50 an hour into I look for beaten down dog stocks with bright futures. I love to look. These are sorts of opportunities that you can double, triple, quadruple, 10x, or more your money in these stocks over time, right? I look for the beaten down dog stocks with bright futures. Good example of this is ELF in 2019. For those of you that have been following me for years and years, you know about that one. Tesla obviously was one of my most famous successful investments. Meta in 2022, Palantir in 2022, right? SoFi in 2024. What a buy that was. AMD this year in 2025, right? These are some of my most famous buys since I've been on YouTube. And those companies, when I was buying them, they were not in favor. ELF, when I was buying that back in 2019, it was $7 stock. Tesla, since I bought that stock back in 2019, I think that stock's gone up like 2,000 or 3,000%. No one wanted Tesla. Tesla was dead money for like a 5-year period. Meta 2022, the stock was down 70%. No one wanted that. Palantir 2022, the stock was down like 80%. People thought Palantir was a joke. Like, oh, what a joke of a company that is, right? SoFi 2024, that was a $6 stock back last year, right? And I was loading up shares, and man, what a game-changing stock that's been. And then AMD this year, like AMD, woo-wee. No, I mean, AMD was an ultra-hated stock just 6 months ago, right? Like people were still selling that stock at $80 6 months ago. Now those same people are willing to pay $250 for it. Like what a change that's been, right? Imagine what they're going to be willing to pay for AMD a year from now, 2 years from now. Can you imagine? Can you imagine that, right? So That's what I like to focus on. Beating down dog stocks with bright futures. That's where I get some of my best returns ever, right? Now, Steve Wynn, so I have a picture of Wynn Resorts on my main phone and my backup phone and my backup phone, right? And the reason being is I always respect Wynn Company so much, and I love Steve Wynn. Steve Wynn, who obviously doesn't have anything to do with the company anymore, but what a legendary businessman. He always had so many great things he could teach you about business. And one of his famous quotes I remember him saying is he said, "In the valley of the blind, the one-eyed man is king," right? Let that sink in. In the valley of the blind, the one-eyed man is king. And it makes me think about the stock market, because the stock market, so often, everybody's so blind, right? They follow each other around, especially a lot of these Wall Streeters. They all buy the same stocks at the same time. They all sell the same stocks at the same time. They're really just blind out there. Like, they can't see a dang thing. And so all you got to do is come in and like have one eye open, and you can see so many opportunities out there that these Wall Streeters are completely missing. And if they weren't missing these, they wouldn't have been selling Meta for $88 in 2022. They wouldn't have been selling Palantir at $5.98 and $6 and $7 in 2022, right? They wouldn't have been selling AMD this year at $80. Like, these things wouldn't have occurred if they actually just had their eyes open and they could like see what's actually going on out there. But they're blind. They're completely blind. So here I come along. I'm like a one-eyed man out here, like, and like I look like a genius. I look like the greatest thing, because it's like these guys are blind out here, like completely blind, right? So just understand that. That's a great quote from Steve Wynn, and it's the truth. Okay. Alrighty. So what are some stocks I bought? Well, okay. So first up, Fubo. I bought 1,444 shares of Fubo here today. That was around a $5,000 move. I got those shares at $3.42. Fubo, I mean, my gosh, they benefited massively from this YouTube, TV, Disney situation here recently. That was a mess. It was an absolute mess. And from the Google Trends data, Fubo went to the moon in regards to Google Trends data. They must have got so many signups over the past couple of weeks, as well as Hulu Plus Live TV, which now they own. I mean, gosh, both those Google Trends went crazy. None of it's reflected in the stock. I don't even think the acquisition of Hulu Plus Live TV's, reflect in the stock. I don't think their future margins start next year and profitability are reflected in the stock. So, like, I don't think anybody's ready for what Fubo is about to do over the next few years here. And so pretty darn exciting, and what a missed opportunity for a lot of individuals out there, right? Adobe. I bought Adobe stock here today, about a $3,300 move. I got 10 shares at $329. Adobe's just kind of an easy money stock. It's hated. It's a dog stock. No one likes it. They just put up great numbers quarter in, quarter out. As long as Adobe keeps putting up great numbers quarter in, quarter out, this stock will climb right back to $500, $600. Like, they just got to continue to put up numbers, because eventually the whole bearish narrative around the stock will go away. Like, it'll just go away. That's just what that's what happened with Google. Google just kept putting up the numbers, and then eventually people said, you know what, like, we got to give up on this whole negative angle on Google. Like, and that just happened. And so that will happen with Adobe as long as they keep coming in through and putting up great numbers. This one might shock a lot of people, this next move. I bought 100 shares of SoFi here today, right? That might be shocking to a lot of individuals, because SoFi has gone up so much from when I was buying that stock at $6 to now being at $27. But when it comes to SoFi, ladies and gentlemen, like, my view on SoFi is I believe that company has the ability to become a financial giant, right? So when we're talking about financial giants, we're talking about companies with hundreds of billions of dollars in market cap. That's where I think SoFi has the ability to go long term. And so for me, looking at SoFi, I'm like, yeah, the stock's gone up a lot since I bought it, but if they really become a financial giant, like, this will all be actually small money in the end, right? And we could look at Palantir. Palantir was a $6 stock, and then it was $27, right? And you could have said, oh gosh, like, Palantir's gone up so much. It was $6, now it's $27. Like, ugh, can't buy that stock anymore. It's gone up so much, right? I mean, now people pay $170 for it. Just a couple of weeks ago, people were paying over $200 for it. So at the end of the day, like, if SoFi just keeps coming in with great numbers and they become that financial giant, like, $27 long term could look like a great price, right? Obviously, it won't be like a joke price like when I got it for $6, but still. Next stock up here, Celsius Holdings, energy drink company. I bought 100 shares. It was a little over $4,000 move. Bought those shares at $40.73 here today. Their earnings were phenomenal. I love the whole direction that company's going in. They're on their way to becoming a drink giant. There's no question in my mind. And so I don't know what else to say other than the stock's a buy. The stock's on its way to $100 a share. Next one, almost a $7,000 buy here, is American Express. I bought 20 shares here today, $348 I paid for this one. Just a great company that you can just count on, like coming through. You think you got to understand about American Express. There's a lot of things you got to understand about American Express, but American Express is really built around a membership model. So the way we would think about American Express, think about them much more like a Costco, where Costco has their membership model, right? People pay their membership, and that's where they get a lot of their profit from. Think about that kind of like American Express, like people pay that membership and they can get a lot of profit from that. And then people go to Costco and they can make money by, obviously, like, you know, they make margin on pretty much everything they sell. So, and then American Express can make money off of all the fees, right? It could be credit card interest fees, or it could be like merchant fees and things like that. So it's a beautiful model. Like, it's absolutely genius what American Express has going on there. And they have a very loyal customer base, kind of like a Costco, right? And, yeah, like American Express, just a great stock. And I spoke about American Express in a couple of videos recently here on the main channel. One is this members only video. This is for the people that are the members that support the channel here. Brand new stock I'm going to buy. That was a 20-minute video that spoke in depth about American Express there. And then this video, that was a public video where everybody could watch it. I just bought a new stock. That one also spoke in depth about American Express. I do make some points in this video, this members only video there, that I don't make in this video. So do keep that in mind. But man, like, what a great opportunity American Express is. Next stock up here, 10 shares I bought. CRM, Salesforce, $238 I paid for those shares. Benioff, we trust that gentleman. Easy money buy. I bought 10 shares of Amazon here today. I continue to buy Amazon. I've been buying Amazon since 2022. And I just continue to load up on shares. Like, that's just one you can hold for the next 10, 20 years and just feel very, very comfortable and make a ton of money. Like, you know how much money you're going to spend on Amazon over the next 10, 20 years? Like, can you imagine that? Like, why would you not want to own that stock, right? It's at an attractive valuation, and like, they just have so much revenue growth from the ads business, AWS, and from the e-commerce business. Like, you got to own it. This is actually a pretty big buy. This was a very big buy for me. I bought 3,000 shares of Honest, HNST here today, about a $7,400 move. I got those shares at $2.46. Like, Honest, I would say for stocks under $1 billion market cap, the most disrespected best deal in the market under $1 billion. I cannot find a better stock to buy with under $1 billion market cap. In terms of risk reward, like, how much risk am I actually taking in that stock? How much reward potential does it have over the next 3 to 7 years? Like, I can't find anything better than Honest. Like, Honest is the king. Like, look at that income statement, balance sheet, they're right sizing the business. Like, oh my gosh, like, it's just brilliant. And so, you know, people going to miss a big opportunity there, in my opinion, but we'll see, right? Estee Lauder, like, what an opportunity this stock has been. It's now a big money maker for us. It's still a buy. That's the thing. I've already started to make a lot of money on EL, and it's still a buy. I bought, this is a big boy move here today, $8,700 plus of Estee Lauder. I bought 100 shares, $87.56. I paid for those shares. That stock remains a buy, ladies and gentlemen. Nike, $6,300 move here. 63.35. You know, I saw something interesting in regards to Nike I thought was worth mentioning. Steph Curry and Under Armour have broken up. What a waste of a relationship, in my opinion, that was. Like, I think Steph Curry banked on he was going to sign with Under Armour. He was going to boost the whole brand. Like, the stock price was going to go crazy. He was probably going to make a bunch of money off the stock, and man, it just didn't work out. And so now he broke up with Under Armour, right? And this went viral on the internet is basically he was seen pregame wearing a pair of Nikes. How about that, man? How about that? Nike Kobe 6s. And some people wouldn't even know he was an Under Armour athlete, because you know why? He's got Nike symbols all over him all these years, right? And, you know, it just shows you, like, Nike has got it down, man. Look at Jordan Brand. Like, you wouldn't even know he was wearing Under Armours because he's got Nike all over him, right? So Nike's just, man, they got it down. They got every angle you could ever imagine. Next one up here, PayPal. Bought 100 shares of PayPal here today, $6,200 move. Got those shares at $62.30. Such a hated stock, such a beaten down dog stock, right? Big news happened here today in regards to PayPal. You know what it was? They just announced they're going to sell off a massive amount of their buy now, pay later business in terms of the actual loans to a company specifically for the European side of the business. And this is a similar announcement that they had back in 2023. And the reason it's so big is this keeps PayPal an asset-light business model. PayPal does not want to be a bank, right? They want to be a fintech. They want to be asset-light. They want to be higher margin, higher growth, higher revenue, right? They don't really want to take a big risk on all these buy now, pay later loans. So they go ahead and sell off that business to somebody else and they can deal with that, right? Next one I bought here is Cheesecake Factory, 100 shares here today, $44.55. I paid for those ones. A little under a $4,500 move in regards to cake. If you want to hear me talk more about cake, I believe that was one of the stocks I featured on this video that I released 2 weeks ago. 4 stocks to buy now, November 2025 edition. So you can hear me talk more in depth about cake, okay? A lot of drama going on short term in the market. It's going to be what it's going to be. You can't control whether the market goes up or down in the short term. Neither can I. None of us can. But you got to focus on the long term. We know where does the market go over the long term? It goes higher. We know where do great companies go over the long term? Higher. There's a lot of opportunities in the market to take advantage of over this next year, and we got to be there to take advantage. But you got to know what you're doing in this game. You don't know what you're doing, you aren't running your projections, you aren't running your numbers, you don't understand the income statements, balance sheets, you're going to be in a world of hurt, ladies and gentlemen. You're going to probably get in the wrong stocks. You're going to probably sell at the wrong times. You're probably not going to buy at the right times because you're not playing the game based upon fundamentals. You're playing the game based upon throwing darts at a dartboard. You do not want to do that, ladies and gentlemen, okay? So make sure you take advantage of that Black Friday sale we're going to have for 1000X to sign up for the sign-up list. That will be pinned comment in there. Enter in your name, email, enter in your phone number. Because if you just put your email, your inbox is going to be flooded with crap. Black Friday, you're probably not going to see it. And you're going to miss a huge deal going on there. And you do not want to miss that sale because we're not going to do another sale on 1000X for quite some time. So make sure you guys take advantage of that. We'll have a deal for a monthly membership. We'll also have a deal for a 3-year membership. And then we will send your steel card to you. Much love and have a great day.